if he's not mentioned and acknowledged. He has led a lot of initiatives, such as establishment of the Ghana Fixed Income Market, the Ghana Alternative Market. He's also a member of the National Board Bond Market Committee. He's a project manager for he was the project manager for automation of GSE operations. You know, GSE operations have been automated since 2008. So when COVID hit us, the exchange was already automated, which was very, very positive. He was also a project manager that led the establishment of the GSE Securities Depository and a full member of the Chartered Institute of Marketing Ghana. Ladies and gentlemen, let's welcome to the podium the MD of the Ghana Stock Exchange, Mr. Eko Afezi, to give us the welcome address. Let's welcome him with a round of applause.
Good morning to all of you. I was just telling Jerry that I didn't know he was going to introduce me. Now, I'm sure people here can guess my age. After telling you that I've worked with the Secretary for about 31 years, and that's very true. The Director General of SEC, my very good friend, Reverend, the Deputy CEO of NPRA, a very passionate person about pensions, David. There's a professor also sitting there. He's also very passionate about pensions. I just heard him having a serious debate with NPRA. So during question time, we'd like to hear your voice. Pension fund managers gathered here, asset managers, licensed dealing members, invited guests, present and online, members of the press, management and staff of GSE. Ladies and gentlemen, on behalf of the management and staff of GSE, I want to welcome you all to this special workshop, which is on the theme, maximizing investment returns using the Ghana Stock Exchange, which has been put together in collaboration with NPRA and SEC. I want to start by commending NPRA and SEC for their support in putting this workshop together. I'm an old school, so I'm still using paper. You see Reverend and David using electronic gadgets when they are speaking. But the paper still works. This workshop could not have come at the right time or a better time than this, as stakeholders like you are so crucial to the development of the capital market in Ghana. This workshop will seek to share the turnaround story of Ghana Stock Exchange and also the current impressive performance that we are witnessing. And we are hoping that will continue for some time to come. And also share with you the opportunities that are bound for players like you in the pensions industry, fund managers, etc. GSE's vision is to become an internationally recognized securities market relevant to Ghana's economy by providing an efficient securities market for national economic development through access to capital and investment. That is our vision. And in pursuing that, we'll be carrying out various initiatives and activities in order to become relevant in this economy. For those who know, we currently have 3 different markets, providing a diversity of products that you can invest in, and also that issuers can also raise capital by issuing various types of securities. So we have the main market, we have the alternative market, and we have the latest kid on the block, the Ghana Fixed Income Market, which was set up about 6 years ago. So far, we've had about 16 billion cedis raised through these 3 markets. Equity doing about 5.4 billion over the 30-year period, whilst the bond market that was established just about 6 years ago have done about 11 billion cedis through the issuance of corporate bonds. Over the 30 years period, we've had about 5.5 billion cedis worth of shares traded over the period. But on the bond market, in just 6 years, we've had about 350 billion, a B, trades occurring in the last 6 years. The capital market ecosystem today comprises over 250 different players, covering regulators, exchanges, stockbrokers, fixed income, dealers, trustees, fund managers, etc. As we speak, the market is doing extremely well, and we are hoping that will continue. The index, as of yesterday, was 35%. It dropped from 36.1 to the day before to that. The market in the last 6 months have grown in volume by 24% as compared to the same period last year, and 58% in value as compared to the same period last year. On the fixed income market, we see an impressive 107 billion cedis worth of bonds traded, representing about 117% over the same period last year. Indeed, it is almost about 100% of what was traded the whole of 2020. For pension fund managers and asset managers and others gathered here, there are many opportunities that GSE provides. And to be good for all of us to start making sure that we can take advantage of the opportunities that exist on this market. Pension funds, we've noted, continue to increase their investments in fixed income securities. But then that same thing cannot be said of equities, where we've had them doing very little there. And that's one of the main reasons why we are here today, to let them know that over the 30-year period, averagely about 25% returns have been made on the equity investments throughout the 30-year period, which is way better than the 12% and the 13% that you think you are getting. And your funds are for a long term, and therefore you need to think seriously about investing in some equities. Growth in equity investments is critical. It's very critical for the development of our economy. There's no doubt about it. If we don't have pension funds investing in equities and businesses generally, we're not going to see this economy grow. It is also because of the fact that they hold most of our long-term funds. And indeed, without them, it's going to be very difficult to have this economic growth to the levels that we are looking at for. You heard of the Ministry of Finance now looking at other ways of trying to create long-term funding for companies through the setting up of the development bank, which will be mainly debt. But we want to encourage pension funds to get into the equity space. And that is the only way we can grow our economy. As an exchange, we have a 3-year strategic plan, which picks most of the key pillars that we intend to achieve within that period, falling under the 10-year capital markets plan, which was developed and launched recently by the Securities and Exchange Commission. One of them is the diversity of products in our markets. We're going to be having, by end of this year, and an OTC market. The rules are with the DG. He has promised me that by end of this year we surely have it. I've cornered you here. We are working on establishing a green bond market or a green market where you will have some sustainability financing taking place. It's not too difficult to set up a green market. Very soon we'll come out with the rules as to how you can list green bonds and other products on that market. We started working on derivatives market. So, you know, you're going to have, apart from the equities and bonds that we currently have, you have other types of products on our market by close of next year. We've intensified our engagements in trying to get more listings on the market. So we've been talking to many companies from the fintech area, ICT generally, insurance, banks, etc. So that is one key thing we also need to do in order to get more. One other thing that falls under the capital market plan, which interests me a lot, is how to increase the investor base, generally. The investor base in Ghana is very, very low. It's below 2%. In other words, we have below 2% of our people investing in securities generally. If you go to the CSD, we don't have more than 1 million accounts. And about 80% of those accounts are holding debt. That is treasury bills, government bonds, etc., and just about 200,000 holding equities. We need to improve upon that. I don't know the target that was set in the plan, but we need to move quickly to almost like 5 to 10% in order to contribute significantly to the development of the economy. The other thing that we're trying to do is to improve the infrastructure of the market, which is also one of the pillars in the capital market plan. So what are we doing? One of the key things that we are doing is collaborating with fintech companies in order to develop very convenient digital solutions. We want to take the action to the doorstep of the investor, so that the investor can just pick up a mobile phone and be able to invest through his broker anytime T, be able to access the market for information at any time T. And that is what we want to do as quickly as possible. Come in 2-3 weeks' time, we'll be launching one of them at maybe this place or the exchange. So that's one of the key things I want to do when it comes to infrastructure, improving the technology that we're using on the market. And last but not the least, we need to educate our people about investment. Without investment, there's no future. You need to invest for your future. And that is why it's important that we have all of you gathered here. You're holding the pensions of so many people, over 1 million workers, right? Or 2 million workers in Ghana, and other people. How you invest them and the returns that you make for them is very crucial to them. And it's also crucial to the development of this economy. So all these initiatives that I talked about are aimed at transforming Ghana Stock Exchange from what we call a frontier market to an emerging market, and therefore become the preferred platform for investment and capital mobilization to support national economic development, as enshrined in our mission. We can only achieve this when we have the collaboration of all of you, regulators, pension funds, regulators, asset managers, license dealing members, and all of you gathered here. So I thank you so much for attending this very important workshop, and I wish you a very fruitful and successful program. Thank you very much.
Thank you very much, MD. Can I please give him another round of applause? One of the key statements that he made, which all of us should make an effort to engage people on, is that he said, without investment, there's no future. So we need to, wherever we find ourselves, we need to encourage and get people to actually invest so that all of us can enjoy a better and a brighter future. Next to speak is a seasoned banker, an investment professional. He's also an investment actuary with proven business development experience, an executive presence with over 20 years progressive experience in pensions and fund management. He is a former AD of GSC with Data Bank and of GSIA with Fidelity Asset Management. He's a founding CEO of Fidelity Asset Management Limited, now Fidelity Securities Limited, and a former treasurer of Fidelity Bank, and a member of Actuarial Society of Ghana and CFA Institute. He's currently the Deputy CEO of the National Pensions and Regulatory Authority. Ladies and gentlemen, I now welcome to the podium Mr. David Tete Abe-Ame to give us his remarks. Let's welcome him with a round of applause.
when they read such a long profile about you, your academic credentials and your technical expertise, a lot of the time it can be positive and it can be negative. There's so much expectations. But nowadays, I do less technical work. And as a regulator, together with Abena and Mr. Kwafezi, we try to sensitize the market on pensions. I was at Asesewa the first time a Ghana traveled that long journey along mountains, and I was at Asesewa on Tuesday during the holiday to sensitize the informal sector about pensions. And this was a call by the Minister of Employment and Labor Relations that we need coverage of the informal sector, because from the statistics, about 11.2 million working population, only 2.2 are in the formal sector contributing to SNET. So there is a big chunk there who are not on any form of pension or the other. And he has given us to move this penetration from 3% to 40% by 2026. And I believe that in that kind of coverage and mobilization of contributions, we'll be able to channel some onto the stock market, as we'll come to talk about it. So DG of SEC, Osofo, was with me at Data Bank as my head of Christendom so many years ago, and I'm happy that at the time that I became the Deputy CEO of MPRA, he's also the Director General of SEC. The MD and DMD of the Ghana Stock Exchange, Mr. Kwafezi and Abena, we go way back. When I was an ABO at Data Bank Brokerage Limited, Abena was at SAS, and Mr. Kwafezi was still at the Ghana Stock Exchange. That is in the 90s. And at a time like this, we are all at the forefront of regulation and championing market penetration. So I'm very happy that I am associated with this thing. So when they brought the issue to us at the MPRA, my CEO put me in charge, and because of this long history of collaboration along my career, we've been able to make this program successful. And I also want to welcome the service providers of the pension industry, the corporate trustees through the chamber. I think I've done very well. We were able to give access to the Ghana Stock Exchange directly to the chamber to be able to bring the corporate trustees. And then we handle the employer-sponsored schemes from the Standards and Compliance Directorate. And that is how we work together to make this workshop possible. So, ladies and gentlemen, good morning. The CEO of the MPRA would like to extend his support to this wonderful collaboration with the Ghana Stock Exchange in discussing the way forward, how pension schemes can invest on the Ghana Stock Exchange in making real impact in the Ghanaian economy. I remember when we were going to review for the third time the investment guideline. Osofo here happened to be the chairman of the review committee. The board chairman of the MPRA said that this time he wants the investment guideline to affect the real economy. And for that matter, when we are reviewing it, we should consider that. And I'm happy to say that as I come along to show you some statistics, you realize that the new one which the board will approve and will come to play with you, the service providers, you will see certain introduction of asset classes that will help to achieve that purpose. The Ghana Stock Exchange and its listing and membership requirement to issuers of securities on their market makes it an appropriate avenue where transparency and accountability on the use of funds invested can be assured. The continuous collaboration among regulators and markets will also go a long way to ensure the stability of the financial security system in this country at a time when the trust in the whole sector is low. I saw that at Asesewa when a lot of the market women were asking questions about microfinance company that have duped them, fund management companies, susu collectors, and it was very challenging. I was there with the minister and my CEO, and you could see the mistrust on their faces. We were there with some service providers.
Good morning, ladies and gentlemen. With your permission, I will stand on existing protocols. And let me start by bringing you greetings from the Securities and Exchange Commission. And I'd also like to commend the Ghana Stock Exchange for this initiative of bringing together pension fund managers, pension fund trustees, and other relevant stakeholders for this workshop. For the SEC, we subscribe, or we believe, or we support this initiative because indeed it falls within our mandate. Our mandate, captured in our vision, is to regulate, innovate, and promote the growth and development of an efficient, fair, and transparent securities market in which investors and the integrity of the market are protected. So what that means is that our mandate is to ensure that when pension funds are being managed, they are managed well. And we do that because if you take the three service providers within the pension space, we regulate two, that's the pension fund managers and then the pension fund custodians. Apart from that, we also regulate the market infrastructure, which includes the Ghana Stock Exchange, the depository. We also have oversight over collective investment schemes, which constitute one of the asset classes that pension funds can invest in. Before you have an IPO or a bond issuance, it comes to us for review, examination, and approval. So in many respects, our mandate does impact the effective management of pension funds. And that's why this workshop is of interest to us. I also want to say that I'm happy that today we have gathered here pension fund trustees and managers. And I say this because I know that institutional investors have been key and continue to be key for the capital market. Until 2004, it was the case that you would never have a successful IPO without the participation of SSNIT. But in 2004, when there were some other institutional investors, mainly the collective investment scheme that had come up at the time, we were able to have the IPO that was successful. And even then, you realize that had it not been for the institutional investors, it would have been a challenge. So pension funds, which falls within the class of institutional investors, definitely is important. We know, and if you look at the statistics, the Ghana Stock Exchange have shared some very good statistics to us. If you look at it, you see that both in the debt market and the equity market, the pension funds are doing well. Of course, the room of improvement is never full, so they can do more, especially on the equity front. I looked at one of the tables that is part of the, I think, the equity release in the pack that we were given, and looking at the ranking of investor type for the first half of this year, January to June, in terms of volume traded, if you add the portions that's attributable to institutional investors, you'll find that over 90% of volume traded is attributed to institutional investors. So that underscores the fact that institutional investors are important, and so it's good that we have the pension fund trustees and pension fund managers and other relevant stakeholders here for this workshop, for us to examine the benefits of investing in the stock market, or how to maximize returns. Of course, the goal of pension fund management is to ensure retirement income security. That is, if you go to NPRA, that's their mandate or their key pursuit. But I just want to add that while safety incomes, retirement income safety is important, there's also the element of how you grow it so that it can be adequate in taking care of you during injury time, or is it beyond injury time, as the Deputy CEO of NPRA just said. I decided to just take a look at 2010, just to look at, if you invest in the equity market, how would it have been? So I just looked at 2010 and then, currently. So if I take the GSE Composite Index, cumulative returns from 2010, January 2010 to date, cumulative is over 220%. If you annualize it, that will be around 11%. Quite apart from that, I decided to, and take note that within this period, and it's a 12-year period, if you count 2010 to 2021, it's 12 years if you do the count year by year. And the observation is that you have a split. 6 of those years, the market was in the red. 6 of those years, the market was in the black. Okay, so that is the context. But within this time frame, cumulative returns for the market index, or the composite index, cumulatively was 227%. If you try to annualize it, that would be around 11%. But then I also picked a few of, if you like, the winners. And there was, I think I picked 3 of them, or is it 4? And the returns quite interesting, cumulative over the period. Just trying to bring out the fact that it pays for asset owners like pension funds who have time on their side to direct their monies into the stock market. I'm going to give you the numbers. I'm not doing any adjustments with inflation or depreciation of the cedi. But when you hear the numbers and you have an idea of where inflation and depreciation of the currency has been, it will be clear to you that it's worth it for pension funds or institutional investors, for that matter, to look at the market. So BOP, for instance, within this period, 2010 January to date, they've posted returns over 400%. If you take CalBank, within this period, cumulatively 250%. GOIL, within this period, cumulatively 812%. GCB, cumulatively within this period, 630%. Okay, I'm just trying to say that it's not all doom, because like I said, within this period, 12-year period, 6 years, the market has been in the red. So it's possible if you take your time to do your analysis, your technical analysis, your fundamental analysis, you will be able to pick stocks that with time you would see that they would return some interesting returns to the portfolio. Now, today, if you look at what a fund manager or an analyst would typically look at in determining how cheap the market is, it's very clear that it's a very great time to consider investing in the market. So for instance, we like to talk about the price-earnings ratio. If you look at the market price-earnings ratio, is 5.4 times. Great. If you look at it for the banking stocks, or, it's even more exciting. If you take the market price to book, it's below 0.92 times. And so if you look at these metrics, it's clear that the stock market offers significant opportunity for you to maximize returns on the funds you're managing. And like I said earlier, especially if you have time on your side, which pension funds do, because pension funds are basically long-term plays. And let me quickly mention two things which, back in the day when I was on the other side, I used to espouse when talking to people about investment, because people will say, well, you're giving us all these nice statistics. Is it, possible to know when to get into the market and, get the best? So there are these two quotes I just want to share with you before I get to the end of my speech. I'll be ending soon, because my job here is just to say that it pays for you to direct pension funds to the capital market. One is the fact that time in the market is more important than timing the market. Time in the market is more important than timing the market. This is because your ability to time the market is not guaranteed. But the numbers show that when you have picked, of course, when you have picked the right stocks, with time, you'll find that it will give you very interesting returns. And I've given you some real examples from 2010 to date. So time in the market is more important than timing the market. So I think that is something that I would like you to remember. Then the second one, which also excites me a lot, is the fact that in investing, and especially when I talk about investing in equities, in investing, you pay the price, but what you get is value. I'll repeat and explain. In investing, you pay the price, but what you get is value. Okay, now this quote means that price and value are not the same things. Price is different from value. So I think when I was being introduced, it was mentioned that I have a book titled 31 Days to Financial Independence. I did a reprint recently. The selling price is 25 Ghana cedis. Now, I can decide, assuming I was selling it here, I can decide that I will reduce the price to 5 Ghana cedis, because you are such lovely people, and everybody will pick one. The fact that the price is 5 cedis, or has been reduced to 5 cedis, doesn't mean that the value in the book has been reduced. That's what we mean by, in investing, you pay the price, but what you get is value. What this means is that when you're talking about investing in equities, you should be concerned about, am I getting a fair price, or better still, are the prices of the equities undervalued? And when you do that and you take a position, you'll find that you'll be positioning yourself to get some good returns on your investment. So I highly recommend investing in the stock market to all, especially those who have patient money. Bear in mind also that apart from what we typically talk about in terms of capital gains, it's also possible that when you invest in shares, you can have some periodic inflows of cash from the payment of dividends. And that can even help you to meet some of the liquidity requirements in managing your scheme. And so that needs to be remembered. And the fact that, the stock exchange or the stock market does offer the room to exit when you have come to the end of your desired or preferable holding period. So I'm totally sold out on the view that pension funds must patronize the equity market more. Of course, it's good that we have pension funds patronizing the bond market. Is great. But as you know, you must always diversify your investment. So you have some debt, but also have some equity. And I'm just saying that if you look at the numbers, it pays. I didn't manufacture the numbers. I just took the numbers. And these are not projections. It's just looking back at what has happened. Let me end by saying that the SEC is very committed to strengthening and making our market more attractive. We recently launched the Capital Market Master Plan, which has 4 main pillars. Mr. Ekwafezi in his remarks did mention them, increasing the diversity of products available on the market, and he's talked about some of the products that will be coming. He tried to corner me on one of them, but I'll not make any commitment here. But we definitely are poised to ensure that we create the framework for more investment opportunities to come on the market for asset owners or pension fund trustees to consider. We have another pillar of increasing the investor base to bring in more people to play in the market, including pension fund managers, pension trustees. Then we have the pillar of strengthening or improving the market infrastructure. And again, there are a number of initiatives that we are supporting. We will be supporting the Ghana Stock Exchange aim to ensure that they migrate or transition from a frontier market to an emerging market. And of course, the last pillar has to do with improving regulation and enforcement to give more confidence to capital. And I just want you to know that we are committed to ensure that we do everything that it requires to make the market, the securities industry in Ghana attractive. In the past 2 or 3 years, we've already taken some initiative. We've issued the conduct of business guidelines, which deals with corporate governance issues for all market operators, including the Ghana Stock Exchange, and then the fund managers and all the other licensees that we have. We have also issued the corporate governance code for listed securities to make sure that corporate governance, which was cited as one of the sources of the challenges that we've seen in the financial sector, so we need to address it. So I'm just here to say that we are focused on our mandate to ensure that we have an efficient, fair, and transparent market. The vision of the Capital Market Master Plan is to ensure that we have a deep, efficient, diversified, and well-regulated capital market with a full range of products attractive to both local and international investors. And that is our commitment. And in achieving that, we need all stakeholders to come on board, all collaborators in the ecosystem to play their part, to chip in their contribution. And as we build the Ghana Stock Exchange, the capital market in Ghana, as we experience some decent returns on our investment, it becomes a win-win situation for everyone. Thank you for your attention, and let's have a great workshop this morning.
Thank you very much, Reverend. Can we give him another round of applause? And thank you very much for the great insights you have shared. And the 2 statements that you made, that will stick with us for a long time, is that time in the market is more important than timing in the equities market. It means people have to be patient. And then when you are investing, you pay the price, but what you get is value. These statements will stick with us for a long time. Thank you very much. We want to acknowledge the presence of Mr. Thomas Kwesi Isso, who is the Executive Secretary, Chamber of Corporate Trustees. Sir, if you are here, we acknowledge you. We also want to acknowledge Mr. Winston Nelson, who is the President, Ghana Securities Industry Association, and he is here with the Executive Secretary of the Association, Ms. Marian Jani. So we acknowledge you, and we thank you for coming. The seminar itself is now going to start, and to do that for us, we have a very experienced and astute stockbroker and investment banker. He's an investment consultant, and he used to be the MD of Car Brokers. Was doing a lot of investor education, and he's a known face in this industry. Ladies and gentlemen, we welcome Mr. Ganesha David Tete to run us through the workshop.
Good morning. Let me follow in the footsteps of my senior Reverend to stand on existing protocols. I wish I can hold the mic and walk around because I want this to be very interactive. Obviously, as senior people in the market, you are not here to listen to me teaching you about equities, but we want to get to the bottom of why, in spite of the large pool of funds we have domestically, 22 billion and above, we don't have a corresponding flow of funds in the equity markets. So I will start with going through a few highlights, statistics. All the people who spoke have presented a lot of numbers and a lot of data about the market. So I'll do a few highlights about that, and then we can get interactive. I'm not sure this breaks COVID protocol. Okay, I'll still try. But many years ago, when I joined this market, I think it was about 2002, as stockbrokers, we used to dream of having a lot of liquidity in our markets. We had a very small local investor base, a few, SNIT being the number one, and all of us will run to SNIT looking for trades on the stock exchange, and then we had the foreign portfolio managers who were all chasing for trades as well on the stock exchange. We were dreaming that one day we will have a large pool of funds or multiple institutions that we could go to ask for funding to buy equities on the stock exchange. So when around the late 2000s, when we were talking about pension reform and introducing pension funds, we were very excited in the market that, look, we are going to have institutions managing funds, and we are going to see a lot of liquidity on the stock exchange. So when it was put in place, 2009 onwards, we were all very happy. But as the years went on, we realized this wasn't changing much. You know, we had so many fund management companies coming in, over 150. I think about 3 years ago, before the shutdown, so many fund management companies coming in. So many pension funds, corporate trustees, individual trustees. A new crop of people had come into the market managing money. So we were expecting that, look, this is what the Ghanaian economy needed. The stock exchange market was going to boom. We're going to see many companies coming to tap into this capital, and we're going to see, faster GDP growth. But fast forward, we are in 2021. We do have a large pool of funds available, but it has not reflected the way we wanted it to on our equity market. It's never too late to give it a go and make it work. But across board in the country, wherever we go, and we've done a lot of outreach to companies, companies talk about the fact that there's no capital in Ghana. We don't have access. There's no money in Ghana. When you tell them about pension funds, say, no, we can't get money from pension funds. They say that the regulation doesn't work. You can't take money from them directly. Said, yes, you can't take money from them directly because you need to be protected. They need to be protected. Nobody wants to lose their pensions in the long run. So you need to put money, or you need to go into the ecosystem where you are allowed to take money from pension funds. So is there an ecosystem where you can take money from pension funds? Yes. You can get equity, you can get debt, and the Ghana Stock Exchange provides that. So why is this not happening? I've also heard from fund managers, because we've spoken to them severally. Why are you not buying equities? Because you heard Reverend, the numbers are good. The statistics pan out. The returns are good. So why are you not buying equities? We've heard some of the fund managers say, it's the trustees. If I buy equities today and it drops, and I go for my quarterly meeting, and I'm showing a negative return, they will take the money from me and give it to somebody else. Trustees, is that true? I've heard that. We've spoken to some trustees. They say, the fund managers, they don't come up saying they want to buy equities. And some of us, we really also don't understand what it is all about. For what we know, in my personal experience, as I've heard from a trustee, I bought AGI shares. I was expecting a lot of dividends. Nothing happened. When I wanted to sell, for 6 months, I couldn't sell. So I don't want to go near the equities market. And I will not advise any fund manager to put money in the equities market. We hear those stories. And there are about 3 or 4 stocks which have fueled this. AGI is one. CPC. PBC. You know the story. ETI. Completely destroyed perception around the stock market. But is that what it actually is? What is the reality? We think the reality is a little bit different. Yes, people have faced liquidity challenges here and there. But how has the market performed? It's not. Okay. Maybe, Jerry, you can roll it on. If you are a broker and you used to trade on the floor of the stock exchange when we were writing on the boards, we had some individual investors who would come and stand up there in the gallery and give instructions to brokers to execute trades. I don't have his permission, but it's public knowledge that Daniel Ofori is one of the largest individual investors in Ghana. I was there when he started trading on the market. He eventually abandoned his entire business, at UTC, Whitechapel then, and put a lot of money into stocks. I mean, many years ago, curious as we were, we checked, the portfolio was worth more than 50 million. Right? And the growth in there was in triple digits. So there were individual investors. The stock exchange used a trader from Abosi Okai as an example in their adverts many years ago. So there are individuals who were taking advantage of the stock exchange and making very good money. So we thought when pension funds come in, they are the ones who will be jumping on this bandwagon and will be making the returns to the benefit of future retirees. But again, it's not happening. So let's look at the numbers itself. I think as for the stock exchange and the 3 markets, previous speakers have spoken, about it, that we have a main board, we have an alternate exchange, and those 2 markets are for raising equities. And then we have the fixed income market, which a lot more of you are familiar with. But we have 2 boards for equities. The main board is what the stock exchange started with. There are about 35 companies there. And then we set up an alternate exchange, mainly for SMEs to raise money. They have about 6 companies that are listed on the alternate exchange. There isn't much activity on the alternate exchange either. The dreams, the plans of seeing funds flowing to Ghanaian SMEs who will make an impact on the economy and fuel our GDP, it didn't happen, or it's not happened, or it hasn't happened yet. But these are the three markets that have been set up, and the infrastructure has been set up for companies to come and raise money from people like you, so that the long-term benefit on the economy will flow to all of us, and then to our pension, our retirees in the future. Let's go on. So, stock exchange has three markets. Can we get this to work? I think it will be okay. Good. Good. Okay, that's better. So the stock exchange has about 35 listed stocks across equities. The fixed income market has 203. The GAX has 6 companies. But let's delve into some of the history of the markets. And I hope you can all see the screen. We have just 37 listed equities. And if you look at the trend, it's about 1.3 companies every year over the 31 years of the stock exchange. That is not good enough. Okay, there are various reasons, and most of you know, as a culture, people don't want to list, people don't want to share, ownership, but it's not where we want to get it to be. If you look at market cap, right, currently now about 61 billion. If you take out the impact of the cross-listed companies, like ETI, AGI, this drops even further. But if you've heard about the Buffett indicator, you would want your local stock exchange to have about 55%, to market cap to GDP ratio of around 55%. We are not there yet, but the stock exchange should be more representative of companies that exist in an economy. So we are working together and hoping that this partnership will lead to that. If you look at the equity raised, I think MD mentioned it, that overall, over 5 billion has been raised on the Ghana Stock Exchange. The biggest one being MTN, raising 1.1 billion. But even that, I understand there was a lot of back and forth. You have to go to the MPRE to seek waivers, etc. So does it mean that the entire process of raising capital from fund managers like you is too difficult? Is that a deterrent for other companies that want to raise money because they don't want to go through this? Are we going to see an improved regulation in the new one, which will make it easier for companies to raise this capital, because the capital is available, the companies are on the other side? How are we putting them together? So maybe it's one of the things we'll also discuss. But 5.4 billion has been raised on our exchange, so it is working. If you look at equity volumes traded, when I mentioned when the pension funds were coming in, we were expecting that this gradient will actually be straight, because if you are going to get on a monthly basis people contributing to tier 2, tier 3, and you have a significant allocation to equities, and we were trading on the market, this gradient should have been maybe straight from 2009, but it's still, very, very flat. If you look at the value traded, it's the same, until we had ETI later on, and MTN has had a more significant impact on our values traded recently. But then again, not too much activity from the local pension fund managers. You have a lot of activity from the foreigners. So if you look at the holdings in the depository, it's split almost 50-50 between local investors and foreign investors. So foreign investors, they still love our markets. They still hold 50% of our markets. But if you look at the numbers, it's just 1%. So 1% of people in the depository are actually holding 50% of equities on our market. If you drill down, you see that our fund managers are missing. Essentially, the foreign portfolio managers buy a lot more local equities than our local pension fund managers. That's the fact. So what is it that the foreign portfolio managers see in our markets that our local pension fund managers don't see? The statistics show that they hold more of our local equities than we do. I think I will skip the fixed income market today because you understand that very well. If you look at the cumulative volumes traded on the fixed income market, it's fantastic. So I will skip that. Last year was 100 billion. This year, we are already, exceeding our targets, what we hit last year, over 100 billion. I'm sure we might double what we did last year, probably even go beyond it. That market is okay. We are trading it actively as pension fund managers. We are increasing our volumes there. That's fine. But maybe this is the reason why our foreign fund managers are buying local stocks more than we are. So let's look at the history of the Ghana Stock Exchange in the 31 years of existence. This sums up the returns on the composite index. So it measures the performance of all the equities that are listed on the stock exchange. So just like any stock market, you see the volatility. There have been times when the stock market has performed incredibly well, and there have been times when you had a downturn. This is normal for every stock exchange. The DG of the SEC mentioned time and timing. Nobody knows when it's going to turn around, and nobody knows when it's going up or it's going to go down. But if you are looking for value and you look at the gradient, you see that this has been consistently on the upward trend. We'll dig into that more. The all-share index over the last 10 years has been no exception. Volatility, but the gradient is still heading north, which is what you want to see when you are investing in equities, that your long-term play still gives you a positive return. If you do a deeper analysis, this I picked from Bloomberg because the white line shows you the return on the composite index. Usually when we do the return on the composite index, we don't add the fact that you are also getting dividends. So if you add dividends, you see that there's a shift, and that shows in the yellow line. If you look at, so this shows you a mixture of capital gain and dividends, assuming you were invested in the stock market over the last 10 years. And there's quite a bit of a gap because it adds another 133 points. Dividends add another 133 points to your return, assuming you had invested on the stock exchange in the last 10 years. So the numbers DG mentioned was just capital gain. He didn't even touch on dividend. When you add dividend, you see that there's a significant upside on your returns in the last 10 years if you had invested on the stock exchange. Maybe this is what the foreign portfolio managers are watching, are seeing, but we are not. Then let's look at the individual years of returns on the stock exchange. So 31 years. This also, we've tried to confirm that the stock exchange is reflective of the things that are happening in Ghana's economy. So if you look at the graph, and 2 of these years, the stock exchange was the best performing market in the world. Okay. Yes, there have been times when there have been negative returns. The longest run of a bull market that we've had is in the last few years. It's in the last decade, where we've had a financial sector cleanup. Before then, we had a power crisis. That was when a lot of multinationals were moving out of Ghana. So we also had negative returns. Then it affected companies on the stock exchange. So you see a negative return. Before then, we had the global financial crisis, 2008, 2009. 2008, the world economy was, going through a crisis. The impact was felt in the local market in 2009. So every negative return that we've seen on the stock exchange has been correlated to something that is happening in our economy. So don't let anybody tell you that our stock exchange is not reflective of our market. It is. The evidence is there. Okay. But look at the positives versus the negatives of investing in this market. There have been years where the stock exchange have delivered triple-digit returns, dollar returns, because the exchange rate was stable, inflation was quite low, so people were getting triple-digit dollar returns. Maybe this is what the foreign portfolio managers are looking at that we are not seeing. Now let's fast track to this year. The history is clear, the returns are there, dollar returns, CD returns, top-notch. Even twice adjudged best performing stock exchange in the world. The foreign portfolio managers see this and they buy. This year, over 36% CD return. How is it in dollars? Almost the same, because the CD has been very stable this year. So foreign portfolio managers are getting over 30% dollar returns by investing in the Ghana Stock Exchange. What is it they are seeing that local fund managers are not seeing? Today, we are presenting this in front of the people who are holding the bulk of the money in Ghana, telling you that the returns here are real. The foreign portfolio managers are buying and maybe helping to provide a decent pensions for people out there. We should be doing the same for our own pensioners here in Ghana because the returns are real. Okay. Now, people talk about, you see negative returns. Yes, it's a stock exchange. There will be negative returns. But overall, do the negative returns compensate? Or do the positive returns compensate you for the negative period? The answer is yes, a very big yes. Okay. Now, we've looked at the 31 years of the existence of the exchange. And I've broken it down into 10-year bands because let's say you want to invest in 10-year bands. You invest in the long term on the exchange. Averagely, the stock exchange has delivered 25.4% return every year over the last 31 years. Averagely, 25.4%. If you make that better, every 4 years, if you were investing on the stock exchange, your money would have doubled. And this is without dividend. This is just pure capital gain. So if you look at it over the last 30 years, if you had invested on the stock exchange, every 4 years your money would have doubled. And I haven't added dividends to this. Isn't that what you want somebody who has worked for 30 years and is going on a pension to enjoy? This is the kind of returns a pensioner would look at. I look back, I worked 30 years. In my contribution, I had an average of 25% growth in my pension contributions. I think your retirement will be comfortable. Again, maybe this is what the foreign portfolio managers are seeing that we are not seeing. If you look at the 3 decades, in the first decade, 29% average return. In the second decade, it was even better, 35%. In the last decade, it has dropped. Obviously, because we've had more challenges in our economy. Is this going to stay with us for the next decade? I'm not so sure. Yes, this year, which is the beginning of the 4th decade, we've had 36%. So what is going to follow? Probably good news. We are coming off a pandemic. The changes are happening in the economy. It will reflect on the stock exchange. It has started, and it will reflect on the stock exchange. This is what the foreign portfolio managers are seeing. We should be taking a closer look at what is happening here as well. I broke it down into 5-year bands. Some said 10 years is too long. How about 5 years? So let's look at each 5-year band. And even if you look at 5-year bands, there's still no negative return. None at all. No negative return. Yes, you have low returns, but there's no negative return if you do the analysis in 5-year bands. So is our stock exchange really, really that bad? Maybe not. First 5 years, 33%. Next, 25%. The third one was really, really good. That's when you had 54% average. It drops down to 16, 18. And in the last 5 years, yes, we've had financial sector crisis, we've had a pandemic, so obviously. But even then, we had a positive, it's low, it's 2.3%. It's low, but even then it's still positive. It's not negative, even if you were investing in 5-year bands. We are starting another 5-year band this year. We've started from 36%. Where is it heading? Shouldn't you be on that bandwagon now? So the numbers don't lie, right? So this shows you that investing on the stock exchange over the last 31 years has actually been very, very positive. If you invest in 10-year bands or 5-year bands, it's still positive. Even if you were doing buy and sell, you had an active portfolio, you were trading, that is when you can even cherry pick and it gets even more exciting. Because then you have 150, 200, 400% numbers that you won't see anywhere else unless you are doing illegal business anyway. But you can find those numbers here on the stock exchange. So I tried, say, in the last 10 years to compare it to money markets because that is what everybody sees. But if I was putting my money in money market, it would be better, I'll get more returns. But you can't put all your money in the money markets, can you? The first rule of investing is diversification. So if you had diversified into the stock exchange, again, if you look at the last 10 years, in spite of all the troubles, you will still have a positive return. But if you look on year, and this is where I think some of the fund managers whisper quietly about the trustees to us. You say if you were in 2011 and you were presenting your composite returns to your trustees, and you showed that on the money market side, between 91 to 184, you were getting 10 to 11.8%, but your equity portfolio had dropped to 3%, by 3%. The trustees will question you. Trustees, is that true? And the trustees are unhappy because when they compare your returns to another fund manager who only stuck to fixed income securities, their average return is higher than yours. So they say that manager is performing better than you, and so they want to give a bigger allocation of funds to them. Is that the case? But if you fast track and you go looking at the 5-year bands and 10-year bands as I've shown you, you realize that overall, although that fund manager had a short-term hit, negative return by investing in the stock exchange, over the next 5 years, he's going to perform much better than the one that didn't. The statistics are there, the numbers don't lie. So why are we not investing in equities? What is the real problem? The numbers here show that the stock exchange has delivered very positive returns. Short-term, medium-term, long-term, it's still positive. So why are we not there? Is there another problem? Is it that we don't understand? Could it be? But what is it that foreigners are seeing that we are not seeing? Maybe this is what they look at. So it's time for us to start looking at these numbers now. Right? Taking a closer look at what can I do to also get into the returns that the stock exchange is delivering. So we talk about the conundrum. I think David from the NPRE, my senior, mentioned it quite clearly. If you look at the asset allocation of pension funds, as recommended by the NPRE, you can go up to 15% for equities, but you are not even at 3% yet. Even for corporate debt, where there's a lot of activity, you can go up to 35%, you are just around 2.4%. So why is it that there's a lot of return, as I've shown, on the equity markets? Positive, sometimes triple digit, sometimes real dollar return, consistently, long-term return on the stock exchange. But the allocation of pension fund managers in Ghana to that space is still below 2%. Why? What is the problem? So that's the conundrum that faces us here. The stock exchange, you think about it, you talk about it to fund managers, with trustees. Everybody has their own perspective. Thankfully, today we are all in the same room, so we can talk to each other, and address the concerns. Why is there a good return on our market, but a very low allocation from pension funds? Is it the regulator? They said it's not the regulator. They have given you the freedom. They give you the signal. So they've given you the signal to invest in equities. Or is it the brokers? Are the brokers not coming to you to tell you about the stock exchange? Or is it the exchange? Have we not marketed ourselves properly for you to know that you can make a return? What is the real problem? We'd like to hear from you to make it as interactive as possible. And thankfully, you have all the most powerful people here who can take the decisions if you tell them. You have the DG of the SEC, you have the Deputy CEO of the NPRE, you have the MD of the Ghana Stock Exchange. You have brokers, the Ghana Securities Industry Association is here. You have a lot of seasoned brokers here, seasoned fund managers and seasoned trustees. Today we would like to find out what is it that prevents you from investing on the Ghana Stock Exchange. At least we have told you that the stock exchange perception is not true. Unless, of course, you don't believe the numbers that I've shown you. But numbers don't lie. So what is it that prevents trustees, fund managers, from investing in equities? Please bring the mic. Yes, I think that I'll like the first question to go to the trustees. The fund managers are happy. They've been asking, or whispering quietly that we should ask the trustees why they don't allow them to invest in equities. So maybe the trustees, you should tell us. If there are some problems too, we will find a solution to them. Because the reality is that the returns are positive. If you add it to a well-diversified portfolio, we will be working towards having a good pension for our contributors. Okay, I don't want to put anybody on the spot, so please, you can volunteer, anybody from the trustees, to start sharing ideas. Yes.
Thank you. My name is Eyor. I'm a trustee. Looking at the bonds you have given, the 10-year bond, the 5-year bond, and basically the yearly breakdown, it clearly tells me that if I am a trustee and I have to make decisions, then I may have to reevaluate my model with this in mind, that if I have a pool with people with different varying ages, who might not fall into the 10-year band, some might fall into the 5-year band, because if I look at my staff, and they all have to go on or reach the, what's it called, the injury time at different times, then of course, I may have to look at the yearly bonds you have given and make decisions. And in that instance, of course, if the 2011 case you gave, I'll be concerned with the negative 3. Because if somebody is leaving at the end of 2011, then of course that negative 3 would affect the decision I have to make. So I think that maybe as trustees, we may have to look at a situation where we classify the collection of people we have into various bands and see what is the best decision to make, which will not adversely affect people who might be leaving or reaching the injury time stages at different intervals. Then we can make a better decision using your bands as a guide. Thank you.
Okay, thank you. Any more perspectives from the trustees? I would like to hear the fund manager's opinion too about some of these, and the brokers as well.
Investing in some of the
Okay, thank you very much. We'll take two more, and then we will.
Thank you very much. So I think one of my questions was my brother asked. The second one I want to ask is that to some extent, the decision to make allocation for funds for the pension side is also influenced by how the investment mandate from the regulator is also given. Like the Deputy CEO said, we are making an effort to provide the mandate, which is good. But it will be very good to know the actual outcomes, because how the guidelines also affect how allocations are made. Currently, as it stands now, like you showed, if I have up to 75% of my funds to be given to GOT or government related, which as a trustee, I know that is a secured or fixed income compared to equity, then definitely looking at the kind of portfolio I run for my members, I am likely to go to that end than to go to equity. I have 15, though is the maximum, all right. But I will not be given the option to make a lot to fixed income funds. So definitely looking at the equity market is not secure market compared to the fixed income. I'll have the liberty to move more to the fixed income than the equity. So like the Deputy CEO was saying, if they are revising a mandate, then I think there has to be a deliberate and intentional strategy from that end, where the mandate's allocation will be such that we will now see a very deliberate effort from the pension funds to move into the equity. But if we still see a lot of allocation going to the fixed income, then like you said, the fixed income market will always be the number one. People will be hesitant to go into the equity market. So from regulators, I think that should also be considered. And one also thing that we are also missing in the whole pension fund issue is that the value chain in the pension fund management is so long, and each variable has its own interest. Unlike corporate entities that can easily come onto the market, the pension fund, you have, first of all, an employer you have to satisfy. You have members or staff you have to satisfy. You have corporate trustees you have to satisfy. The fund managers are actually working according to instructions from the trustees. So if I'm a trustee and my employer, the employer I'm actually administering the fund, has a particular perception about equity, then there's no way I'll be willing to go to that end. So I'll have a particular strict corporate trustee, though I have MPR investment guidelines, I also structure my guidelines according to what the employer and administration also looks at. So we need to also look from that end. Thank you.
Okay, thank you. I see the goalposts are shifting. The fund manager said the trustees. Now the trustees see the employers. So we keep going. But the reality is that we've seen the returns. Why are we unable to tell the employers that as professionals, we are advising you that the returns on the stock exchange as shown, it's good. And so we can have a mix, a well-diversified portfolio where even 5% is in equities. Nobody says don't stay away from the fixed income market, which you say is safe. But why is it 1%? Why is it not 5%? Are we not able to tell the people that, or whoever we report to, that the stock exchange returns are good so we can diversify there? Who calls the shots? Is it the professional who is advising the employer, or is the employer who is a teacher, a nurse, who is telling you, the professional, where to put the money? So I'm trying to see, where does the buck stop? Who calls the shots in this whole value chain? But we'll come to address some of the other issues. The last one, and then we'll address the issues.
Thank you, David. I have a lot to say. I don't know whether the right time.
Maybe you should make it snappy because I see a lot of hands are up. So
My name is Leonard. I work with a corporate and trustee
the starting point is how do we determine our strategic allocation. So for access, we went through exercise with the shoulders, and we realized what the long-term equity pays. And that went into the determination of our asset allocation, the virtually employed organization that we make. And for whatever we realized an asset allocation of between 15% to 20% would, over the long term, give you a better risk-adjusted return than going on a fully negative. So our asset allocation for equity is between 2% and 2% target. We try as much as possible to stick with that. But then I'll tell you some of the challenges. I mean, this year, or since last year, we've been on the heels of our fund managers, fund entities, because we saw the opportunities in our P ratio trading at an all-time low. We saw very good tickets selling at huge discounts. But the truth of the matter is, to date, our fund managers have been able to execute for our trade because of the own liquidity. Having this conference, if at the end of the decision is for us to do as much as equity as possible, then the regulators need to step up their advocacy effort, especially some of the issuers. They will have to sell down some of their stakes, right? I mean, some of the multinationals will have to sell down, especially on the position, because if 2-point-something million of liquidity is moving into the market, trust me, the market cannot contain that. So that is a clear barrier. Now, having said that, I can really understand the role of strategic asset allocation plays in investment returns. So we try as much as possible to take it and truly we've seen the benefits. Now, we ask a question as to some of the challenges that prevent institutional investors from taking equity exposure. For most of us as trustees, our benchmark does not represent the investable asset at all. So you have a pension fund having a 1-year treasury on the bench as a benchmark. And how is that possible? We feel the benchmark should reflect the investable asset size. So if asset allocation is 5% equities, 95% fixed income, then that benchmark should be reflective of what asset allocation is. And you mentioned, in your comments to our colleagues, questions, a lot of our colleagues who sit in the board of trustees are not sometimes investment professionals. And unfortunately, they are the ones who put it short. For our fund managers to engage with them, they took the most of them from out the boards to defend their investment decisions. So they kind of compare the set of questions, why the guy can buy equity and then defend and equity to the trustees. If you bought a big company, you should be able to defend and invest. And then again to our investment professionals, there's no analysis coverage on our market. There's virtually no listed disabilities for most companies on our market. And the trustee sometimes want to know what a particular issuer is doing. And I need to sit down and do my own research. I'm expecting some of the brokerage firms to put on very, very good research. And on the one page, research and that tells me the companies that buy or sell. So we really do expect that. Now, on how can we encourage growth of equity participation market? I've been an advocate of setting a floor. David said that they cannot force on the hands of those trustees. But from the maximum allocation of 10% to 20%, we've seen anything in terms of what trustees are doing. I think it's high time we consider setting a floor to encourage the market. For me, what I'm interested in is encouraging the market. I keep saying, if the viable companies out there realize that there is reward in listing, they will list. MTN couldn't raise the amount that we were looking for. A lot of IT issue of setting the floor. I mean, if a floor is set, when doing trustee meeting, the conversation of the good from why do you buy equity, what fixed income is giving me on the security, and the conversation becomes, why do you buy company A? When really companies B are increasing value, they say 50% above what the market value was. The conversation will start becoming interesting. So that is what I would say. I think I'm
Thank you very much, Nana. Very, very good points raised. Maybe I'll stop. I think MD and Abna wanted to address some of the issues. So we'll address them before we take another round of questions or comments. So Mr. Afezi, you can go. Please bring the mic.
Okay, myself, David, and maybe Reverend also contributed. Let me, first of all, applaud this testimony with the cultural summit somewhere. And something I said, people should stop using that. Thank you for bringing that culture and telling us everything. I mean, I like what Mr. Brommer was saying. And he's telling us the truth. He's telling us what goes on. From listed companies to brokerage firms not doing research, to regulators, whether they can do the Center for, etc. Let me assure you that there are few points made by the gentleman down there. We will have to organize another program where we will bring listed companies together with you. But you made a good point about we don't have the listed companies here, investment nations, then you also made a point about the trustees and custodians not giving the opportunity to invest in some of those companies. Good examples of Ecobank, etc. That was a good point. Then, I'm taking note of all the comments made by the Ron. Research is something that we're encouraging our brokers to do. We'll keep on encouraging that. Reverend was in charge of research for data value to put out a lot of research. I don't see too many of the brokerage firms doing that. I feel them also doing that. We encourage that. At one time, we thought of getting paying for independent research work ourselves. That is their shame. So that we know how that research work is done. It's being done by Nigeria. They get independent people who do the research on the companies and put them out there, they pay them without really influencing what to do there. So we might consider that people don't see a lot of research being done in the market. Then also, we will have to go down to the employers and explain what they mean and explain to the employers. I once had a chance to speak to chairman of one of the trustees for the employer. And we're trying to talk to him about money shares. So you know about shares. Because he bought agency shares of that back. And he lost everything. So you would never know. I said, oh, Ecobank is doing well. Card is doing well. I said, we don't know how to do it. So it's the same kind of information you will transmit to trustees. Trustees will not transmit that to farm managers, then the chain goes on. So we will have to go further down, apart from the people gathered here, to people like him, who's one of the trustees of the pension scheme at his workplace. So we will have to do that. Let me just pause there and let Reverend and David also make some few comments.
Thank you very much. I think the law and the governance arrangement around the law was very much clear to avoid
this thing on the market. When the law started, all the trustees did was that they gave a limited account to the family. That look, take care of the person, I don't want anything to do. Just deal with the trust and custody. Alright? Then there were issues. Because of course investments have up and down. Now, when the issue started, they say it's not us, it's the fund managers. And then we said, look, if you give somebody a contract that has not absorbed him from responsibilities. Like where I sit, my CEO is the spending officer, but he can delegate. The Public Financial Management Act says that even though you have delegated to me to perform the function, it is the ultimate responsibility. So that's why we have to let the boss stop. It stops with the trustee who have the judicial responsibility. He went to enroll the contributor. He went to promise the contributor that I will collect all money from you if you look at section 121. And then when you return, I will give you your money plus accrued interest in a lump sum. You didn't tell me that you go to a farm manager to go and collect the money or a custodian to collect the money. You enroll it. And there were a lot of functions that were applied for the trustee. So the bank stops with them, whether it's a local trustee like an employer sponsor scheme or a corporate trustee of the master trustee. The bank stops with the trustee. And that is why in section 121B, he said that the trustee is supposed to appoint the fund manager and then the custodian and other service providers and ensure they comply with the law. So the trustee is a regulator.
So we go out with the consumer protection policy to emphasize that at the state level, because the law of things not for the great stage. Even those things that make the pension better. And the trustee is the labor of the student to understand that the regulations even put a reporting obligation of the service providers to the trustee. That is what it is. And the trustees are supposed to report the fund managers and the hotel. They are not to report to the trustees. So when we push the thing, I feel disappointed. I'm a practitioner. Maybe at times I've been at your place before. I was managing for 10 months and I was standing at also. This is a great the former English everyone. And somebody will tell me that this is the time you are giving me when you control cement. Hey! China is here very interesting and actually I think, hey! Then you will sit there. You will tell me about this. Maybe the market didn't do well that time. Say, hey! China, you really read through the job. Something will solve you. One time, I was in the office when a trustee called me. Now I was the CEO of Realty Securities Limited. You know what was going to happen? After my presentation of the report, they didn't say anything. They were going to vote last. During the day that we let me take your response. If my CEO sees it, my CEO sees it on the side, so somebody who went there, when the union people were discussing, you are our head, look at the defense man, they never questioned me. So I called him, I said, this is what the union people are planning. So I called the union chap, and it was a trustee meeting. He didn't say anything. Just so. He said, we are uniting with the management of the company not to pay them. So the people are coming from us. What do I want to do? All these things put fear into people to give. But that should not absorb you as a professional. a monthly basis. Also, in Ghana, we say that careful be the year, I did actually. Those of us who grew up in the compound house, you stay with your cousins and your things. So, your mother and your father go to your mother and your father. There was a people who are. So what they do, all of you eat, or even the eating separately, everybody put his gold there and they will listen. So what you are eating, and your mouth is not inside the bowl, and you are just standing when you enter, but they can't be really tiny. They will have finished their food. So they say that come later here. And he actually, your hand is inside the bowl. At least in the extent of the stew, you will leave it. When your hand is moving, and 20 people are inside the bowl, I'm tiny. I can't do it. So someone is telling them, all these things that they will show, the trend. You can only ride on the trend when you are alive. Because if you are planning the market for a time, remember what the ladies place on the road thing. That will do the China is not a funny thing to play. The ladies will go to the team. You watch them. That is how market timing looks like. Market timing had never helped anyone to ride the trend. All the trends were showing were backward. Slowly. And you can only enjoy the trend when you are inside. So my suggestion to you from a professional is that once you get monthly contributions, then you take a portion on a periodic basis into equities. So that over the long run, you will be the trend. And whenever they are showing the trend, you will see that even though you are bound on the average, you will ride on the road. And if you have been at the beach before, you will see how they ride on the road. Simon Lebu, Nathan Yashu, come in the level, the walk that time. They don't have a trying to get past all the way to the road. And that is what I'm telling you. That is false. I can't let the spirit processing speed as speed in thought. But I'm really to direct the people. But I'm just encouraging you guys. Always to ride on the road, you have to be in. Like the saying, be in the market and not in the market. Every quarter, every 6 months, put a percentage of the contributions your cash flows are receiving. Put it in the rest. And then over a long road, like you realize that you are riding that will show you. A lot of time when you do this presentation, you regret it. You start somewhere. So that every time you show all you need to have. And you show that everything else is the same, or the time 20%. Then you know that you will end in the balance and the listing interest. Not 20%. Let us worship the trustees. Please take their responsibility. Educate your self-reliance, educate the players who you think are not well vested. Spend some money to educate them. I know some of the human trustees, they do that capacity building. I can't know their capacity building at all. I think some of them in the state funded for them. And the last business, some of them who were in capacity building. With the master's trustees, the public also improve on it. And I believe that you will be able to understand some of these things. And then that's what pushing you. You went to a lawyer, you told them that give me your contribution. When you retire, I'll give you a lump sum. Smith said that he will pay monthly pension. That is his policy. His financial, his wealth. You said, I'll pay lump sum, and then if we go the rest. Let us keep this simple committee, and let us work around it. We are there to help you. In similar, we expect almost all on the side. Right now, we are at 850. What can we do to improve? If it is operational challenges, let us know so that we can clear the bottle. And you that assist me to clear the bottle first at the same level. And then let us still be free to operate and write on the phone, calling you here, and they actually thank you very much.
Okay, just a few comments from me. So on the investment research bit, I'll just say that let's remember the difference between buy-side research and sell.
That is the question. Of course, the fund manager must be able to demonstrate to you a reasonable basis for making the decision. But I think we need to draw the line between who is making the decision, who is owning the decision, and let them empower the fund managers to make the decision. Let's hold them accountable. Of course, we need to protect the pension assets, so we need to do what we need to do to ensure that the fund managers don't go, way overboard. But that's, I think, something that we'll continue to discuss. Now, on the floor concept, I am sold out on it. I think it's good to have a floor concept. And I can say that unless the a certain proportion, by all means, must be directed to equity. So I think there's something in the offing. So hopefully, that can be addressed, and it can get better. But I totally agree that
there has to be some floor, when it comes to, the investment in equities. And let me quickly say for my family that there must also be a floor corporate trustees on their fees, so that you don't push them threshold, but that's another conversation. And then generally, in terms of information access, which I think is important because for you to invest in the market, you need access to information. So again, I want to mention that we are about to work on what we call the financial data hub. It's a project that we have so that it will be easy for all investors, to plug into that data and get all the necessary information that you need to make a decision. Because really, capital markets or securities industry, it revolves around information. And we have initiated this project because I know what it is. I mean, I've worked in research before, and I know how tough it can be to get information. I think something the reason why investors may shy away from the equities market is because they don't have information that can help them appreciate what maybe the fund managers may be recommending and so on and so forth. And I think that's what someone said, investor relations people of the company this time around. So we are doing that information is an issue, and we are initiating a process to enhance accessibility or availability of information to assist all of us to make that decision. But let's not wait for all conditions to be perfect. Let's get moving, and then we can improve as we get along. Thank you.
Thank you very much. This has been very interesting to hear your comments. One question I want to address on capital gains tax. David, we talked about how the capital gains tax exemption will be. After this year, the government has granted permanent waiver of capital gains tax for securities listed on the Ghana Stock Exchange. So anytime you buy and sell securities and you make gains on it, permanently, zero tax on that. I wanted to let you know that for ourselves and with regards to the issuers and interactions with investors, the stock exchange provides a platform called the facts behind the figures. And we will send out a schedule to all of you fund managers, trustees, with the upcoming ones, so that you can actively engage issuers on this platform. It's something we've been doing for years. We need to step up and do more of that. So we commit to that. There are a few more coming up. I think we'll add 2 or 3 so far. There are a few more coming up. In fact, we do note that we need information to invest. So the stock exchange, since the last 2 or 3 months, has designed a special fund managers a market monthly report targeted at trustees and their fund managers. And you will have received, or many of you will have received, requests to sign up for these reports from us. And we put your mailing list and we are sending these out to you. Please, if you are not on our mailing list, just indicate or give us your approval. We will make sure you are getting this information on how the market is doing, how the companies are doing every month. If you want a higher frequency of daily information on the market, we gave you the opportunity to take your options as well. Please sign up for that. I think the liquidity matter is something, today's event is critical. I think the liquidity matter is something that we will continue to address. One of the companies I had the privilege to work with in my investment banking career was called New World Renaissance. And New World Renaissance followed on from a company called New World Investments. And it's at New World Investments that I learned how Mr. Bambi had worked for several years touring all over Ghana and finally managed to get the teachers of Ghana together, to come together and create management like private pensions industry. And I went and looked and saw how with less than 10 US cents per teacher per month contributed collectively to a fund. It became and managed by a stockbroking firm, invested mostly on the Ghana Stock Exchange and a few in fixed income securities, treasury bills, and so on. It became this behemoth that has now transitioned into real estate, credit facilities, etc. The Teachers Fund had a leadership, and here I really and had what would today be the trustees, and they were very committed to listening and working with their investment managers. And they manage these funds, and today we see the buildings they put up on the Independence Avenue plus all the other things that they did. What I'm here to encourage all of us is that the statistics we showed about the performance of the stock exchange is true. Foreign fund managers are benefiting from this, taking the returns tax-free out of Ghana to pay people in Canada and Switzerland, etc. better pensions. And it's just happening if our own fund managers, the team we work for and fought for the privatization of a part of our pension scheme, do not take up these opportunities. SNIT, I must say, for many years, was a very active investor on the Ghanaian stock market, offers in the field without SNIT. And they definitely proved playing their role very, very actively a few years ago. I know now because of some of the payments they need to make, they haven't participated as actively. But the other point of investing is that it's about when you buy and when you sell it. And the start of this engagement is to equip the trustees and the fund managers with the tools about how you can analyze your investments, determine when you met your investment objectives, and get in and get out of those investments as well. Even as you follow the Deputy DG's advice to commit X percentage of the funds every month into investment on the stock market. Thank you.
My name is Apostle Nasimokofi, portfolio manager for SNIT Equities. And I just have a few points to make. As to why I believe that individuals and perhaps institutional investors are not participating in the equities asset class. The first point I want to make relates to governance. And there I would want to zero into the holding of annual general meetings and EGMs. What we find is that you have a prominent shareholders association, which seems to be getting a bit, should I say, they are aggressive and having some sort of majority voice in quotes when it comes to shareholder meetings. And until recently, I see that most of the questions that they raise are to do with praises of companies and don't go in depth into analysis of the performance of these companies. And when we, as institutional investors who have analyzed the performance of companies, want to get in and raise questions, sometimes you realize that they are telling the company that you have to carry out and finish the EGM or AGM. So literally, you find them, even though I can believe that we don't have a majority stake in most of the companies like SNIT have, controlling the holding of these agents from, I don't know whether the management point of view or so. And I think that needs to be addressed. Again, we've also looked at the situation of how the independent directors are selected. And I don't know whether maybe some lawyer may speak to that, or you can speak to David. But I find it a bit of a problem when you have board members who are shareholder representatives being the ones who nominate independent directors who are supposed to be protecting the rights of the minority in minority in some cases. So perhaps we can react to that, because we can have situations where they end up not being independent, but speaking to the tune of the board members. Again, you've spoken about reporting, and when it comes to reporting, we have had a problem sometimes with the information that is given. We, as institutional investors who have family interests, are also being very active in the monitoring of our companies. In fact, by a rule, we are supposed to monitor each company twice in a year. So in these activities, we have had some resistance from some of the companies indicating that we have a shareholder as we have board representation, and they are not able to understand the dichotomy between being a board member and being an equity investor. The board member is on the board, but we, as having invested from the point of view, have a right to monitor our investments, and we also have a right to information. So when it goes on, you look at the accounts and perhaps you see that some are giving some information. For instance, information on general and administrative costs are just bulked, and you cannot get details on what the breakdown is. And I believe that perhaps some advocacy can be done by the Ghana Stock Exchange to ensure that all firms give us relevant information that will help us to better make investment decisions going forward after we make investments in the company. Again, and then there's this issue about the company's code has been reviewed, and it says that I don't know the statement with retrospective effect. Auditors, there's something about auditors, a number of years that we can have an audit firm. There are some of these companies who have had the same auditors from inception. And I think that does not hold good for good corporate governance, and that also needs to be checked by the exchange. We also want to state that in your analysis, you said that the stock is in between more years, and that dividend payment is also very key. I must admit that in the past years, SNAIF has had to do a lot of advocacy to ensure that some companies pay dividends. And we do that way in advance before the actual AGM comes on board. So when people see dividends being paid, they don't know that some serious work has been done behind the scenes. And so, for instance, for SGSSB, we did that sort of advocacy last year, and we forced them to pay dividends. Again, this year, we see that they are silent on the payment of dividends, even though the bank has become on board. And that's something that we are taking up. So I think, generally, if we see that it is possible for us to invest in equities, we do that. But if we have challenges with these, and also with companies that we've already invested in, like CPC and BBC, then we raise a few questions. Thank you very much for the opportunity.
very good ones to buy Smith. Clearly, we all have our little challenges and issues here, but I see that none of them is a deal breaker for us to be invested in equities. All the people here, SEC, NPR, GSE, regulators, they are listening. I'm sure they'll be working toward it. There's still some ground to cover as part of the workshop, but I understand that coffee has been waiting for a long time. So the rule is that we'll step out. It's packed because we are following COVID-19 protocol. So you just step out, grab a pack, and then come back in. We'll give ourselves some 10 minutes so that we don't lose the momentum. We can quickly wrap up and then have lunch. So we'll have a 10-minute coffee break. You can step out, grab your pack, and then we'll come back in and continue. So those of you who are watching on Zoom, I got notifications here that they want to ask questions. So there are fund managers and other industry people, as well as individual investors watching us on Zoom, and they want to ask questions. So if you are watching, please put your questions in the chat box, and then the technical team will forward the questions here. So put your questions into the chat box on the Zoom portal, and then we'll answer them. So 10 minutes coffee break. Thank you very much. We've heard from SNET, we've heard from the regulators. I will continue briefly with a few highlights on my slide, and then we can continue the discussion. We would want to hear from as many fund managers and trustees as possible. We would like to get to the bottom of what the bottlenecks are so that we find solutions to this problem. At least getting our local fund managers, which is our local money, to be invested in our local stock exchange. We've removed currency risk. A lot of issues also came up during the break. As always with such workshops, when you go on break, those who haven't had the opportunity to speak and those who don't like to speak publicly express their opinions. So a couple of things have come up which we will look to address when we finish with the slides. From experience, some of the fund managers chase the market. A lot of the fund managers have seen or have heard and have read that the stock exchange has gone up 36%. Suddenly they are all up sending orders to brokers, how do we buy, what should we buy? And then when they send the orders to these brokers, and I've heard examples, you have a stock trading at 1 cedi. The fund manager sends an order and says, I want a discount, I want to buy it at 80 pesos. There's usually no reason. It just feels good to buy at 80 pesos because he's buying cheaper, forgetting that very soon you can be on the other side. There's nothing heads if you buy at market price. These are comments that are coming from the brokers. There was an example in 2018, and for most fund managers, especially pension funds, that was the first time that they started buying equities. At least the statistics show that early 2018, the market had gone up by about 15% in a month and a half. Then we saw orders coming from pension fund managers in January 2018, and the market went up. I think it crossed 30%, really overheating. And then we saw a mad rush of pension fund managers coming in, and the prices were just shooting up. But do you know the people that were selling to local pension fund managers? Foreign portfolio managers. So foreign portfolio managers started exiting when the prices were heating, and local fund managers were chasing pricing, so they were buying. By half year, the market had turned around, obviously, and immediately the market came down 10-15%. Local fund managers panicked and started running, and it sent the market even further down south. So a note of caution as well: when fund managers are coming into the market, do not rush to push the prices up. Take your time and do the fundamental analysis and look at value. And this is, I defer to what the DG said, look at value. Because when you rush into the market, you push the prices up, and then when the prices are going down, it runs equally as fast, with no corresponding input from the company in question. But market prices must reflect the performance of the companies that you are buying. So the herd mentality, and we see a lot of that from local fund managers, unfortunately. Don't follow the crowd. Understand the equity that you are buying before you make your move. Take your time, study it, go in there for your long-term play, and then you will get the value. So don't chase the market. Last year, foreign portfolio managers were buying. They started buying last year. Our local fund managers have been away. They have started seeing the gains. This year is 36%. Our local fund managers are coming back. Guess what? They are asking the foreign portfolio managers for a discount so that they can buy. Again, we could be making the same mistakes. We saw it in 2018. We want to avoid it now. So brokers maybe don't rush the prices when you get the orders, and the fund managers don't ask for excessive discounts because the market has already been, very much undervalued. So let's all play within a space where we don't rush prices up, rush prices down, and then the whole world sees that the stock exchange doesn't perform well. Let's stick to value and pricing when we are trading on the exchange. Another issue that came up, the trustees are giving the fund managers short-term contracts. But if a trustee gives a fund manager short-term contracts and he knows he has to deliver his returns in a year or two, he's not touching equities. Is it true? Are the trustees giving fund managers short-term contracts? It could be a possible reason why the fund managers don't want to come near equity. They want to deliver fixed income returns in the short term so that they are retained for another season. The trustees would like to hear from you on that. Are the trustees too powerful? Are the trustees too powerful? I'm hearing yes and no. They have to be powerful? We would like to hear comments around that. Should the regulator be cutting down the power of the trustees? The jury is out there. And of course, we've heard things about the quality of companies on the market and the challenges with governance issues. But then there's another one. If you look at Ghana today as a country and our problems, our successes and our challenges, GDP 72.3 billion. Last year, COVID pandemic, we slowed down to about 1%. We have a high public debt to GDP ratio of 71%. Okay, depending on how you look at it, unsustainable levels, or maybe we can revalue our GDP. It depends on where you sit on the economic side. The SME contribution to GDP. When I say SME, in Ghana, almost all our listed companies are SMEs. So SME contribution to GDP is 70%. SME contribution to employment is 49%. So it follows, if you want GDP to grow, you want faster GDP growth, you grow your SMEs, right? It's logical. So grow the SMEs. And if you want to create jobs, you must grow your SMEs, okay? But what happens? How are SMEs funded? Bank funding to SMEs, around 20%. If you look at the bank's balance sheets, about 60% is in government securities. So we are sending the money back to government. Pension fund money, 70% to government. So how do we expect our economy to grow when the key driver of that economy has limited access to funding? That's the conundrum we find ourselves in. And we should be worried, not as fund managers, trustees, but as Ghanaians and people who live here. Because you have children, they will grow and they will want employment. Which companies are they going to work for? Who is going to create the employment that will employ your children and your children's children? If we continue to give 70%, 60% to the government because we have short-term contracts and fixed income will give us 80% and it is safe. So where is the economic growth supposed to come from? So all of us must be worried as individual Ghanaians about the future of our country. So apart from all the numbers that we've mentioned, we all have a key role to play to ensure that our country grows. And within this room are the people who control the money that can turn around our country. Next time, don't blame anybody. Within this room are people who hold the keys to the growth of our economy. If we start funding SMEs, those employment numbers will grow. And that contribution to GDP will grow. It just follows, it's logical. But most of the money is going to the government. So it's critical. Apart from the fact that the GSE gives you returns, let's look at the wider picture. We couldn't have left here without looking at this picture. Okay. Now, we are saying that funds must go to the real economy if we want GDP to grow. Funds must get there. Yes, we talk about safety, we are afraid. But who should grow our GDP for us? Who should grow these SMEs for us? Is it the foreigners or is it ourselves? It should be us. And if we have created 22 billion in funding, sitting here in Ghana in cities, and we have a large pool of SMEs that require funding, that will fuel our GDP. But we are saying that we are afraid. So what should we do as a country then? Should we go outside and bring money to develop our SMEs before our fund managers will buy? Clearly that doesn't work. So there must be a bridge between $3 billion in funds that we ourselves own. It's our money. And then our economy, which is starved of funding and requires SMEs to grow so that our economy will grow. It's simple. If you fund SMEs in your country, when you go on pension, you definitely get a good return because GDP would have grown. So who should grow the GDP for us to enjoy when we go on pension? Isn't it our own money? That's the conundrum we face. Now we've been working at the stock exchange level, different levels, to try and get companies in the real sector, the real economy, to come and tap into this funding. Thankfully, regulation has been set up, infrastructure has been set up to allow this. But we sit here and we are worried. These companies in the real economy that we need to grow, when we bring them into the market infrastructure that we have set up, will you take the decision to fund them? Will you fund them? That's our conundrum. And if we are not going to fund them, where should we take them to? So there's been initiatives. We've spoken to governments. We are talking about some strategic state-owned enterprises that can be left, can be divested, so we can bring in private sector funding to grow these companies to the benefit of all of us. And when I say strategic, I don't mean these are companies that you won't buy. They are good, solid companies that are profitable or near profitable that will benefit us. And when I mention the names, you know them. For example, Ghana Gas. For if Ghana, the government wants to divest Ghana Gas, should we sell it to foreigners again? So the work is on, but if we bring Ghana Gas to you, will you buy? That's the answer. So where should we take it? So the gas resources that we find in Ghana, that produces gas and produces electricity for us to use in our homes, ownership of that asset must go to who? Well, I throw the questions out there. I'm asking you, who should ownership of these assets go to? But we are talking. Government is listening. People are listening. So we have all these companies that we want to bring into the infrastructure of capital markets that we have created. But we are afraid about the response. We are afraid of the response. But we need to do something. It's our country. It's our money and it's our pension. All of it is ours. We need to have some catalyst that will start changing this status quo. So we've got companies that are going to be divested from SOEs in oil and gas, insurance, infrastructure, agribusiness, banking, real estate, manufacturing. This will help diversify the offering of companies on the stock exchange, which we are all craving for, and make the stock exchange more representative of our economy. And we spoke about market cap to GDP. This is how we can achieve it. We've been talking to privately held blue chip companies, names that you know. You patronize their products every day. We've been talking to them. But when we talk to them and they say, how sure are you that when we bring our company, we will get people to buy? Our answer, we show them the table of 3.6 billion available in pension funds that can buy. But would they really buy? They will. They are sitting here. Will you really buy? These are blue chip companies in Ghana, privately held. Will you buy? We don't know. Okay, I like the yes. I heard it from Axis, so I'll take note. And then there are some SMEs which are poised for growth. We've had the challenges about the GACs, or some of the companies there, the value, they don't offer too much value to our shareholders, we won't invest in it, etc. But like I said, we have a conundrum as a country that we need to fix. So yes, we are changing the narratives a bit. We are speaking to, for example, PEs that are looking to exit the market. You've already invested in a company, you've put in some work, you've turned it around. It should be investor ready now. So why not exit through the Ghana Stock Exchange? But when they are exiting through the stock exchange, will you buy? That's another question. The money is there, but will you buy? We want the answer to be yes. There's a nice ecosystem that I've drawn here about funding the real economy. On the right side are people like you and others who have money, including insurance companies. We have collective investment schemes that have allocations to equity. They are all sitting on the right side. The stock exchange is sitting here, ready to provide debt capital, equity capital, and those who just want liquidity. You list by introduction and you get liquidity. And the issuers are there who require to tap into this market. So what we are trying to do here is to ensure that those on the right side are ready, willing, and able to make the funding available when we bring those on the left. Again, I know the MPRA's guidelines and others are creating channels for alternate funds. It's not all the companies that are investor ready that can come to the stock exchange, yes. But there are other avenues like private equity schemes, private debt, alternate investment vehicles that hold these companies, work with them, and then will exit on the stock exchange. So money, again, we're working in an ecosystem. We are not competing. So if a pension fund manager gives money to a private equity fund to go into some SMEs, 5, 6, 10 of them in a fund, you grow them over 7 years, you exit on the stock exchange. It's the same pension fund managers that will be picking these companies in the long term. So we have a nice ecosystem of value chain that we've created that is funding SMEs in Ghana. If SMEs are funded, we are growing jobs. We are growing jobs, GDP growth is to our benefits. It's a simple structure that we can build if only we decide or we take away the fear and then we fix the bottlenecks that we are discussing. But we need to do this for ourselves as a country. In terms of equity strategy, I think I'll skip that because most of you know exactly what you're doing in the fund management space. Or we need a full class to tell you about how you can analyze equities or how you should. We need a full class. I'm sure the stock exchange will be happy to organize one. And we've got brokers, seasoned people who will be, willing to take you through the various steps to go to analyze equities. But there are certain indicators you look out for, right? Basics, there are about 10 of them. Earnings per share, price to equity ratio, right? Projected earnings growth, price to book value, and this is the minimum. Price to book value, I mean, if you know accounting, you know valuation, it's the minimum value of a company, the book value. And as of last year, we even still have some companies that trade below book value. I mean, how sweet can this be for an investor? It doesn't get better than this. Companies that are trading below book value. So if you buy into this company and the company even gets dissolved, the returns you get after the liquidation is more than you put in. It's a no-brainer, below book value, right? It's one statistic. Free cash flow, dividend payout ratio for those who want income, right? The return on equity, dividend yield, debt to equity ratio. The issue is how do fund managers get reports or analysis that will give them these indicators? Very valid question. So the brokers must also step up and provide this information to these fund managers. But there's another side to it. If you go to Bloomberg, and maybe most of you don't use Bloomberg, you'll be amazed what happens there. I mean, I know that there are companies in Ghana, brokers in Ghana, who have analysts who cover Ghanaian stocks that are ranked. Do you know that Bloomberg has a ranking of analysts for companies on the Ghana Stock Exchange? If you pick FundMilk or you pick GCB and you go to Bloomberg, you will see analysts' forecasts and estimates, consensus estimates, and then you see a ranking of analysts. So there are research analysts who make a call. FundMilk, we think we have 52 upside potential in 2021. A research report, maybe an initiation of coverage in January, which says we will get 52% at the end of the year. At the end of that year, Bloomberg will rank your analysis at the beginning versus what the actual is. So there will be 10 or 15 analysts who are covering FundMilk who have all made a call on the price. At the end of the year, based on the outcome, the analysts are ranked, and it happens on an ongoing quarterly basis. So if you go there, you will see the analysts who have actually written research reports about FundMilk, what the outlook is and what the actual performance is. Obviously, yes, this is Bloomberg. We don't use Bloomberg terminals. It's expensive. But as a market, I was happy when Reverend mentioned it. We need to find our own way to make such information available to the fund managers. But they are Ghanaian brokers and analysts who are doing this job. It's available. It's there. So I know the research that's happened. The buy-side research, it's there. I worked in a brokerage company. I had analysts that were ranked. It's there. It's happening. We just need to translate this information to you. And believe me, some of the local-based analysts are ranked higher than the foreign-based analysts. They cover these companies very well. They understand the equities inside out. So we need to build that bridge between these analysts and you who have the money. But don't say you are afraid. You need to do it, because their records show that they understand the markets and they are delivering the returns. When they tell you buy, it's a buy. When they tell you accumulate, it is. When they say hold, it is. So follow those recommendations. Right. So information is available. If you don't have access to this, there are a few things that you can follow regularly. The stock exchange publishes a daily official list. There's a monthly market report. At least you should be subscribed to that. Okay. We have company press releases. If you are following a company, you are tracking a company, you should look out for the official press releases about that company. Or if you own a stock, there are regular press releases. The analyst coverage report that I spoke about. I mean, brokers must share this a lot more with some of the trustees. Okay. Research reports. I know there are a lot of published research reports, but you need to read them. I see in the Business and Financial Times there are weeklies. About 10 or 15 companies every week are publishing research reports. At least read them. It will keep you abreast with what is going on in the market. The GSE itself also has its own press releases. They hold facts behind the figures for companies. They hold half-year, quarterly reviews, full-year reviews about the market. You should read them. And you should read the stock exchange reports the way you read MPC reports from Bank of Ghana. It will give you a full view into activities on the stock exchange. So you must read them too. It's not just MPC. The GSE is also there. If you want to buy equities, you must read them. There are economic reports. Read them, because they guide you as to industry, sector performance, etc. And then there are also industry reports. So to play in the market, at least these are points where you should pick information to help guide you, whilst you start crafting your strategy for investing in the equity markets. It's a national problem, and we have to fix it. So we'll come back down to addressing some of the challenges that you have raised before we went on break. So I'll go to, I think there was a trustee, there's a pension trustee, and I think we will want to hear more from the trustees and the fund managers, a lot more, before we bring in maybe the brokers and then the regulators. So there's a trustee here who raised his hand, and then Mr. Eso from the Chamber of Trustees, he also wanted to talk. So please let the mic go around. We have maybe another 30 minutes to address all the challenges, and then we can bring this to a close. So I'll start from you, sir. Oh, the mic is not here.
Okay, thank you, sir. On the issue of trustees being too powerful, I don't think so. Trustees are very cooperative. Sometimes, speaking as a trustee who may be required to approve investment proposals, and my fund managers do it very well because they know I ask for those kind of information. It's a kind of research that supports the investment proposal. So just sending a one line, we propose you should invest in this, will not do enough for some of us. Because you have to go beyond that.
The fund managers are not bringing you the correct research reports. So they are not bringing
adequate research to back the proposal. I mean, in my case, sometimes it's very good in most cases. And so when delays or reluctance to approve, it may be because we don't have adequate information to support the decision that is being, or the proposal that is being made. On general issues, I think there has been an issue about the floor for fund managers, and that is where I think I have a bit of concern, especially if there is a flaw and there is not enough available securities. That is likely to lead to, overheating on the market, because everybody is required to maintain a certain level of trade, and so we all have to satisfy that regulatory requirement. But there is not enough available securities on the market, so we all kind of chasing ourselves, and that itself may be. And so I like the initiative to bring more, issuance on the market, and I think that is positive. The information that you also provide, I think it may also be good to indicate the free float available. Because sometimes we talk about market capitalization, but you notice that even of that market capitalization, only about 5% is available for trade. And if I am a large investor, I'm looking at how do I liquidate if I have to exit. And I don't know if it is something that can be also considered as making some of them not traders, more like market makers, so that it can become easy to liquidate those kind of positions, and that I think can also help in the liquidity aspect. And when discussing the returns, I think you also didn't talk very much about the cost of trading on the market. I think the cost of trading in equities relative to the bond market, actually the difference is just too high. Yeah, if you look at a bond, a physical market, trading cost on that market is far lower than trading cost on the equity market. And I think this is something that you should also be looking at. And I think I'll end here. We'll take a few more.
Okay, this is not my turn. And then I want to thank you for the opportunity. I think I am a bit fortunate to be on both sides as a fund manager before and now with the trustees. And then I also sat in meetings where we have trustees actually pushing for fixed income, where we are really advising equities. And you will see that, and I was just telling my friends here, most of the equities that we use as examples are the CPCs, the Anglo-Golds, that have stayed their price for a very long time, and maybe ET and IRIS. And you run through all of them. But you ask yourself why you are not using the GCBs and the wells to at least motivate themselves to go into the equity markets. And then I want to also say that I'm glad this forum is being organized to bring all of us together so that we see how we can grow this market. But there are two issues. When another one was speaking, I was very happy because at the trustees level, we've had various discussions and the beginning always to push for equities, and then it's a strong advocate. We know that equities are the way to go if you want to develop the market. We know that pension funds are also pensions capital that needs to be invested for the long term. But like we have said, there are issues that we are all identifying now. That is why I'm quite happy when the capital markets master plan was launched. And then I look at the pillars of which it was actually built, and I think that is the way that we should go. Diversifying products and then liquidity. And then also increasing the investor base, strengthening infrastructure, improving markets, and then also including regulation enforcement. But let me put it here that even though most trustees perhaps may use the argument of returns to not invest in equities, I want to say that it is not actually returns. The problem they are becoming is about liquidity. of the equities when they want to exit. That is the main problem. Like you said, we also as a family, we did an analysis from 2004 to 2014. And we realized that if you invest in the equity market for that long, 2004 to 2014, your real return was actually higher than investing in a 91-day treasury bill or 182-day treasury bill. We knew that it was higher. But we also knew that there were periods where there were negatives. So when we want to advance the trustees on board, they will be making those strong arguments of the negatives. And it is very difficult, let me confess, it's very difficult that when you're a practitioner, you're advising, and then your trustees are not practitioner, but they ask you a question. When you know that as a practitioner, that is not the question you should ask. But they try to explain and you never understand. It's very difficult. So yes, I believe that when we are able to control and improve some of these issues, the public trustees will definitely come to the equity market. The question also is this. My regulator is expecting us to invest 4.4 billion on the markets. Like the previous speaker said, how big is the market to take it for 4.4 billion? What is going to be the impact of it on the markets? It's a question that we should ask. Because putting 4.4 billion on the market is not, a joke. The impact will be there. Maybe prices will just be over, equities will just be overpriced. But we need to ensure that we increase the equity base so that we can all invest in it. They are talking, I heard the fund managers talking about trustees being powerful, they have short-term contracts. But the fund managers know that even though their contracts are short-term, they are not of changed. We can talk about that. It's only few that I know trustees, they will put up some key performance indicators, they will run the fund managers, maybe after a period of maybe 5 years, and then maybe the worst the public fund manager will change. But rarely fund managers have stable contracts, even though you can describe them as short-term. I am also happy for the confidence drive for the equity market. I'm so happy because some of us think that pension funds should now be venturing into impact investment to ensure that we can use our own resources. In fact, some of the trustees' position is that let's use our own resources to develop our country. Some of them, talking to them personally, I've been finding ways of how we can be able to take the foreign investors out of our market and own our markets. It is an issue that we've been discussing. One-on-one, you have those conversations and it comes out. So the appetite to come onto the equity market is very high. The appetite is there. Driving the confidence is good. I like that. But the point is that when we start bringing our markets, our funds onto the market, will the equity markets be able to hold those funds? That is the issue. And I think that these are so much fundamental issues that if we are able to control or to improve on them, I can confidently say that public trustees will actually come onto this market. So we are talking, and I hope that we will improve the environment, the ecosystem for all of us, because I can, on behalf of my trustees, I can tell you, we also want to bring the equity space, but there are still many questions, and I believe that that is what we are doing, to answer these questions so that we can bring that space. Thank you very much.
Thank you. David Olsen. But I'd like to hear a perspective from brokers about whether 4.4 billion cannot be invested on the
Thank you very much. I just want to make this remarks, then I will run. But I'm very happy to be here at such a workshop. But whilst you were talking, I was thinking when I was a stockbroker, where was the aggression to the institutional fund manager to buy or sell something? Forgive my language, I'm not but we were aggressive to convince
the institutional investor, which is the farm manager, who is here. Then later on, there was the brokerage, there was the asset management, and then there was corporate finance. And a lot of the time, when I was listening to, they have Bloomberg now, they have analysts doing a good job. So I believe that the broker this time will have a lot to sell. When we were in the market in the 90s, we were depending on Osofo's research to go and sell. And at times in the morning, you are pitching a sell idea to Senate. In the evening or late afternoon, you are pitching a buy idea to Senate. And all these ideas have different strategies, but they were solidly backed by information. And you were so aggressive that you want to have both sides of the transaction to execute so that you double your income. Now, thinking about it when you were talking, the fund managers are not brokers. The authorized dealing officers of the Ghana Stock Exchange are the brokers. The fund manager cannot go and sell stock. They cannot bring stock to them. They cannot bring anything to the equity market. So I'm seeing that the current crop of brokers, forgive me, the current stock of brokers may have lost something. Abna is here. She was head of brokerage at SS. She can testify to what I'm talking about. In the morning, you have some of them have done some analysis. They say some companies should is a buy or something. Every bank will kick your box. You need to go out there and go and convince somebody, a farm manager or an employer or somebody, to buy that thing. And you have to convince him with good and solid research and analysis, not joking conviction. So if the trustees are saying that they are broker companies, I think the brokers have lost something. And then the following time, because you want another one to buy, sell them, and you want to, else you could have closed the sell and go to the market, and then maybe another will go buy from you. But you want to have those sides, and the two solid convictions are different. And we're doing it. So I'm pleading with ABOs here that if the trustees, the fund managers cannot do too much because they don't bring equities to the market, they don't sell equities. It's the ABOs. So, Mr. President, in the past, then brokers were primary dealers in treasury securities. I'm happy to do it with Alexander and KB Kwabrabo Assam. Now, at a point in time, Bank of Ghana realized that the private dealers were not giving him a lot of volumes. Because a private dealer, if they are issuing 2 billion, you need to put your skin. Now, okay, I'll give you 10%. So you go and look for the market. That's the brokerage. Then it was a data brokerage. So you go and look for people to go and buy the bulk from Bank of Ghana. You can do a similar thing with your ABOs. If you think that pension funds, you need to have 4.4 billion on your market based on my signal, and they are not bringing you that money, you can change them. What Bank of Ghana did was that he said that he's changing the PB system. Now, he's giving PD licenses to 15 banks. Now, when I was a treasurer, there was a big responsibility on the bank. Do you know what it is? Anytime there is an issue calendar, as a PD, you need to promise 1/50 of the calendar, the amount calendar. And there was a continual licensing. So, if you are not able to meet your 1/15 for some time, they take the license away from you. And the commission wasn't too bad. You understand? So you as a bank, treasury, you want to be seen as a bidder. Because so what the bank can say 100 billion, for the next quarter and pay this thing, you need to go and look for 150, or whether it comes from your deposit, it comes from your, so then I'll tell my treasury sales team to go outside the bank customers and bring me to keep my big license, because make sure that the big one, you know, just some prestige. I think you need to do your APO same. That 4.4 billion market is there, and they are not selling information. That's what they sell to the bank. They are not selling the analysis that they will be doing today. That is what we saw, that we didn't have any quality or anything in our hands. We go and convince also SS and then a person want to convince SS to do an IPO or something to target is my goodness. The aggressiveness was there. Maybe they don't have the idea of selling on the stock exchange, but you need to bring you to earn your money. Fatting your APOs. Maybe you need to get some pension APOs and incentivize them. And maybe I think they have a licensing obligations by the exchange. If there are some things similar to, so that they are then able to say they should specialize in that one, give them some incentive, and let them go after the farm managers, give them the information to be able to convince the trustees, go to the trustees, give them the information to be able to work with their investment committees and the farm managers to give them business, because it's them who come and trade on the market. It's not the farm managers or the trustees. They will come and trade on the market, and if they don't have money from the farm manager, or they don't have equities from the farm manager, they can't buy or sell. They sell equities from farm managers or IPO, and then they can buy from the market. So I think you should look at it. Finally, and this is also this is just an idea that is not a good idea. It's my personal opinion. I just want to make that disclaimer before I make it. Yeah, no, I'm talking to my colleagues here. You see, I've been thinking, this farm manager, trustee who is powerful, who is not powerful. You see, it is about yes, it is about where the fiduciary power lies. Now, in a lot of markets, there are no trustees. They are pension fund managers and custodians in Nigeria, or they call them pension fund administrators and then custodians. The fiduciary power lies with the pension fund administrators, who double the fund management activity and then the administration and then custodians. In Ghana, we have three. We have the trustee who does the administration. So the trustee in the global space is a pension fund administrator. Now, we've taken the pension fund management function out, but the custodian has always been constant. So now, this is just if there's any right change and the debate keep going, should we take the fiduciary responsibility for the pension fund administrators who are the trustees and give it to the pension fund managers, and then say that the pension fund managers who will make the investment decision and manage the assets of the AUM should have the fiduciary duty, but comes with liabilities and responsibilities as well. So that the pension fund administrator does only the administration without the fiduciary responsibility. So that, like what you do in your law, the farm manager is the fiduciary. You understand? He enrolls the people, he sponsors the scheme, and all those kind of things. But if we do that, then the trustee will take in the fiduciary and call him the pension fund administrator. Give the fiduciary to pension fund manager. He manages the fund, he makes the investment decisions, and then the trustees do the administration. The custodian will still do his custody. Or we make the two and call them something else, and they have both the fiduciary responsibility and then the fund management. That is what is going to solve who is powerful. The power lies in who has the fiduciary responsibility, because it comes with liabilities it comes with responsibilities as well. And if the pension fund retires, where is he going to take his money? Is he going to the pension fund manager or is he going to the pension fund administrator? And that is where the power lies. So until we change the law, I would say that the pension fund administrator, who the trustee with the ultimate fiduciary, hold the power. And they must use it well in such a way that no retiree will sue them for adequacy. That I gave you my money after 10 years, I'm coming for it. You have cheated me like they did to 37 for killing that woman today. They find them penalty 1.7 million. Time is coming that if you don't use the fiduciary power very well, somebody will go to court and you will be jailed for misappropriation. And that one is 10 years minimum, and there's some penalties. So thank you very much. I think we need to look at this more. Change your videos, and then we will change the law. Thank you very much.
Thought-provoking from David. I thought, but we will still allow a few more comments from the trustees and then the fund managers. I see trustees saying the brokers, they are not doing your work. Brokers say the trustees, the fund managers are not doing their work. Trustees say fund managers are not convincing them. Fund managers say trustees are giving us short-term contracts, so we are afraid, otherwise they'll change us. Some of the trustees too say the employers are also calling the shots. So somebody somewhere is not doing his work well. But I think together, if we all start, we could get this wheel rolling. Are there any additional comments?
Thank you very much. My name is Yao Kusiejan from Enterprise Trustees. Okay, so I think I want to comment on the issue of governance. So the way governance is managed generally in the country, and the impact and the experience that recently we have all gone through has made some of these decisions that we want to take here a bit more difficult. And if you go to the companies to see listed, see some of them have governance issues. They have big governance issues, so it makes it a bit more difficult for us to push the pension funds to those companies. I know many trustees have had to deal with that issue. And then when the issue also comes up, we are told that we are responsible, and therefore we need to take up that responsibility, which indeed the case. And that means that we'll have to be very much more careful when you are taking the decisions to make sure that you will be able to provide a good account of what has transpired to the members. The second issue is the fact that indeed the trustees satisfy so many stakeholders, but the key stakeholder actually is the member who will be going on retirement, and then will be walking to the trustee's office to take his or her benefits. And so the issue of equity investment comes in over here. And we see that when you share value on equities, you are not only talking about part of the return that you are getting that is going, you're talking about true value. And so the impact of that on the fund is quite significant. And I believe those who have been doing analysis from our side will see that. But we are not scared about that. What we want to say is that we need to be able to separate those who are near retirement from those who have many years to retirement and then make that decision. But making that decision also comes with some complexities on the skills that we manage. Because currently, an employer has all the employees trustees, some of them near retirement, some of them fresh, they are all on the scheme, and then you need to be able to, as an administrator, manage that at the back end to make sure that you'll be able to satisfy the young and those who are not yet going on retirement, and then for them, in terms of investment, be more aggressive and then do much more of equity kind of investment, private equity kind of investment, and all those things that we are discussing over here. So that work needs to be done, and I'm glad that the NPI is looking at revising the investment guidelines to make that possible. But I must also say that it is not administratively easy for that to be done, but trustees will pick up on that, and then we'll do our very best to make sure that we align. The other point that I also wanted to talk about is the fact that the culture that we have here as a people is a short-term kind of thinking in terms of investment. Everybody wants quick returns. We have lost some business because they feel that the returns were not coming up quickly as they anticipated, and then they moved away to other trustees because they felt that they are not seeing the returns. So that kind of short-term thinking, I think, is something that needs to be worked on. And I'm also glad to say that we mentioned here that we are going to take education seriously. And as trustees, as pension fund managers, as regulators, I think that is the way to go. When people begin to feel that this is what we are all aiming at, we want to develop our country, we want to push money to companies who will go and come up to the market, then we will stop looking at the short-term returns, comparing the return that the trustees will be giving or the schemes will be turning out with other short-term securities and their returns on the market, and then that will allow all of us to put the journey together. So I think these are some of the few things that we need to look at. But I also want to say that at Enterprise, we are already even looking at the concept funds on the personal pensions level. So we are promoting that, and that is also aiming at addressing the informal markets, trying to make sure that as many as who want to take advantage of the 30-year pension schemes will do so, and then they will invest according to their age, and then expose them to the equities at the appropriate level. And then those who are near retirement, we place them under the conservative fund to make sure that they do not suffer unnecessarily from IRS. Thank you very much.
Thank you very much, Enterprise. I think we've had a lot of comments from the floor. A few comments coming from our viewers, those who are watching us online. Because this is if trustees are complaining about lack of liquidity, I want to advise them that their activities on the market will help deal with the lack of liquidity, since they will create demand and supply situations on the market. So that's an answer there. Another comment says trustees are extremely powerful. Emphasis mine because it's in caps, extremely powerful. And then wonderful deliberations, but this will not yield much results if the MPRA doesn't find a way of getting the trustees to act. Well, probably also referring to the floor. So a few comments coming from our online community. I think that we have had a lot of deliberations and the time is really running. We still have to wrap up, but the conversation doesn't stop now. Everybody is going to go on the database of the stock exchange, and we'll be having more interactions. I like the fact that we've been open, we've been frank, we've all acknowledged that the reason why we are not investing on the stock market is returns. No, it's not returns, it's something else. There are additional bottlenecks that we all have to try and fix, and we'll be working, day in, day out to try and fix that, so that we can get to almost the maximum allocation recommended by the MPRA for equities. So thank you all very much for listening to me. But I think my key takeaway is that whatever it is our country, it's our money, it's our pensions. So let's find a way to do something about it. Thank you very much. I'll hand over to Jerry. Thank you very much.
Thank you very much. I'm sure we can give him another round of applause. He's been on his feet for quite some time. Thank you very much, David. And thanks to everyone for your patience. We are gradually drawing the curtains down for today's program. We will now call on our Deputy Managing Director, another stalwart and pillar in the investment banking industry, Ms. Abnamwa, to give us the closing remarks. Please, when she's done, because of the COVID protocols, lunch is outside. So you pick a coupon from the lady behind the desk, and then you pick your pack, and then you can give the coupon back to her. So that's the arrangement. So thank you very much. So we now invite Abna.
Good afternoon, distinguished ladies and gentlemen, and thank you very much for your time and for the very fruitful deliberations we've had. First, I'd like to say a big thank you to all of you from the pensions industry, trustees, corporate and employer-sponsored schemes, fund managers, the ADOs here. Thank you so very much. This program would not have been possible without the collaboration and support of the NPRA and the Securities and Exchange Commission for making time to be with us today. Thank you so very much. The Chamber of Corporate Trustees, Thomas and his team, to the Ghana Securities Industry Association, thank you for all the support you've given us. This is a journey that we have started. And I'm happy to again remind all of us that the Ghana Stock Exchange, together with the Chamber of Trustees, have committed to sponsor periodic gatherings like this for all of us here developing the capital markets industry to meet, discuss our issues, and importantly, even out some of the stumbling blocks in our way. So this is the start of it, and we will continue the deliberations that we have started today. It was really fortuitous to wake up this morning and see this headline in today's BNFT: pension funds increase participation in the equities markets. It came at a very opportune time because this is a meeting we have wanted to have for a very long time. And the stars were aligned, and here we are, and we've heard everything that you had to say. The work we need to do at the stock exchange by providing more visibility and access to our issuers, the work our stockbrokers who have to sell these securities to you have to do and how we incentivize them, the work we need to do continuing with the trustees and fund managers to provide information to them that they must invest in the equities market. The work we need to do as regulators to ensure that the rules of the market are observed for a fair, free, and equal opportunities market where all investors meet their targets. And the work all of us need to do, as David showed, to build our economy and create a future, not just for our contributors, but for ourselves and all of Ghana. Thank you very much, David, for facilitating a great discussion this afternoon. And may God, our Father in heaven, as he did in the parable of the talents, to the servant he gave 5 talents to the servant he gave 2 talents to, who invested it prudently and attained rewards. May God, our Father, reward us accordingly. In the same way he rewarded the servants he gave 2 talents to and 5 talents to. And may we never, for the sake of security, for the sake of not working hard, be like the servant who received 1 talent and did the absolute minimum with it. So thank you all very much for your time again this afternoon, and our communication and our next steps will continue, and you'll hear back from us. You'll hear back from us through the chamber and through the NPRA on the next set of training sessions and how we will continue to develop this market. But for us, at the end of the day, we want to see that when the next set of IPOs come to the market, as we are working very hard to do, to bring strong companies for you to invest in, that the pensions fund industry can beat their chest with pride and say, we feel confident in supporting this business. That when the next set of companies come that want to trade on the market, our pensions industry are the first movers in there, buying and holding and trading in these securities to achieve the returns that they need. Thank you very much again.
Okay, so once again, on behalf of my MD from the Ghana Stock Exchange, and with all the support from NPRA, and then SEC, DJ is here, NPRA boss just left us. We want to say a very big thank you to all of you for making time to be part of this program. We really appreciate your time, your contributions, and the ideas that you have shared. And we are saying that we are so grateful to you once again, and we hope to meet very soon. Thank you very much, and enjoy the rest of your day. Bye-bye. start the program, and we want to, at this point, invite the host of the program. But before I do that, I want to tell you a bit about the person that we are inviting. So the one we are inviting to come and welcome all of us has been in this industry for the past 30 years. And he's got over 30 years experience in stock market operations, investment banking, project management, marketing and strategy management. And he has led a lot of initiatives at the Ghana Stock Exchange. And the story of the Ghana Stock Exchange cannot be complete if he is not mentioned and acknowledged. He has led a lot of initiatives, such as establishment of the Ghana Fixed Income Market, the Ghana Alternative Market. He's also a member of the National Board Bond Market Committee. He's a project manager he was the project manager for automation of GSE operations. You know, GSE operations have been automated since 2008. So when COVID hit us, the exchange was already automated, which was very, very positive. He was also a project manager that led the establishment of the GSE Securities Depository and a full member of the Chartered Institute of Marketing Ghana. Ladies and gentlemen, let's welcome to the podium the MD of the Ghana Stock Exchange, Mr. Eko Afezi, to give us the welcome address. Let's welcome him with a round of applause.
Good morning to all of you. I was just telling Jerry that I didn't know he was going to introduce me. Now, I'm sure people here can guess my age. After telling you that I've worked with the Stock Exchange for about 31 years, and that's very true. The Director General of SEC, my very good friend, Reverend, the Deputy CEO of NPRA, a very passionate person about pensions, David. There's a professor also sitting there. He's also very passionate about pensions. I just heard him having a serious debate with NPRA. So during question time, we'd like to hear your voice. Pension fund managers gathered here, asset managers, licensed dealing members, invited guests present and online, members of the press, management and staff of GSE. Ladies and gentlemen, on behalf of the management and staff of GSE, I want to welcome you all to this special workshop, which is on the theme, maximizing investment returns using the Ghana Stock Exchange, which has been put together in collaboration with NPRA and SEC. I want to start by commending NPRA and SEC for their support in putting this workshop together. I'm an old school, so I'm still using paper. You see Reverend and David using electronic gadgets when they are speaking. But the paper still works. This workshop could not have come at the right time or a better time than this, as stakeholders like you are so crucial to the development of the capital market in Ghana. This workshop will seek to share the turnaround story of Ghana Stock Exchange and also the current impressive performance that we are witnessing. And we are hoping that will continue for some time to come. And also share with you the opportunities that are bound for players like you in the pensions industry, fund managers, etc. GSE's vision is to become an internationally recognized securities market relevant to Ghana's economy by providing an efficient securities market for national economic development through access to capital and investments. That is our vision. And in pursuing that, we'll be carrying out various initiatives and activities in order to become relevant in this economy. For those who know, we currently have 3 different markets, providing a diversity of products that you can invest in, and also that issuers can also raise capital by issuing various types of securities. So we have the main market, we have the alternative market, And we have the latest kid on the block, the Ghana Fixed Income Market, which was set up about 6 years ago. So far, we've had about 16 billion cedis raised through these three markets. Equity doing about 5.4 billion over the 30-year period, whilst the bond market that was established just about 6 years ago have done about 11 billion cedis through the issuance of corporate bonds. Over the 30 years period, we've had about 5.5 billion cedis worth of shares traded over the period. But on the bond market, in just 6 years, we've had about 350 billion trades occurring in the last 6 years. The capital market ecosystem today comprises over 250 different players, covering regulators, exchanges, stockbrokers, fixed income, dealers, trustees, fund managers, etc. As we speak, the market is doing extremely well, and we're hoping that will continue. The index, as of yesterday, was 35%. It dropped from 36.1 to the day before to that. The market in the last 6 months have grown in volume by 24% as compared to the same period last year, and 58% in value as compared to the same period last year. On the fixed income market, we see an impressive 107 billion cedis worth of bonds traded, representing about 117% over the same period last year. Indeed, it is almost about 100% of what was traded the whole of 2020. For pension fund managers and asset managers and others gathered here, there are many opportunities that GSE provides. And it would be good for all of us to start making sure that we can take advantage of the opportunities that exist on this market. Pension funds, we've noted, continue to increase their investments in fixed income securities. But then that same thing cannot be said of equities, where we've had them doing very little there. And that's one of the main reasons why we are here today, to let them know that over the 30-year period, averagely about 25% returns have been made on the equity investments throughout the 30-year period, which is way better than the 12% and the 13% that you think you are getting. And your funds are for very long term, and therefore you need to think seriously about investing in some equities. Growth in equity investments is critical. It's very critical for the development of our economy. There's no doubt about it. If we don't have pension funds investing in equities and businesses generally, we're not going to see this economy grow. It is also because of the fact that they hold most of our long-term funds. And indeed, without them, it's going to be very difficult to have this economic growth to the levels that we are looking at for. You heard of the Ministry of Finance now looking at other ways of trying to create long-term funding for companies through the setting up of the development bank, which will be mainly debt. But we want to encourage pension funds to get into the equity space. And that is the only way we can grow our economy. As an exchange, we have a 3-year strategic plan, which picks most of the key pillars that we intend to achieve within that period, falling under the 10-year capital markets plan, which was developed and launched recently by the Securities and Exchange Commission. One of them is the diversity of products in our markets. We're going to be having, by end of this year, and an OTC market. The rules are with the DG. He has promised me that by end of this year we surely have it. I've cornered you here. We are working on establishing a green bond market or a green market where you will have some sustainability financing taking place. It's not too difficult to set up a green market. Very soon we'll come out with the rules as to how you can list green bonds and other products on that market. We started working on derivatives market, So, you know, you're going to have, apart from the equities and bonds that we currently have, you have other types of products on our market by close of next year. We've intensified our engagements in trying to get more listings on the market. So we've been talking to many companies from the fintech area, ICT generally, insurance, banks, etc. So that is one key thing we also need to do in order to get more. One other thing that falls under the capital market plan, which interests me a lot, is how to increase the investment base, investor base, generally. The investor base in Ghana is very, very low. It's below 2%. In other words, we have below 2% of our people investing in securities generally. If you go to the CSD, we don't have more than 1 million accounts. And about 80% of those accounts are holding debt. That is treasury bills, government bonds, etc., and just about 200,000 holding equities. We need to improve upon that. I don't know the target that was set in the plan, but we need to move quickly to almost like 5 to 10% in order to contribute significantly to the development of the economy. The other thing that we're trying to do is to improve the infrastructure of the market, which is also one of the pillars in the capital market plan. So what are we doing? One of the key things that we are doing is collaborating with fintech companies in order to develop very convenient digital solutions. We want to take the exchange to the doorstep of the investor, so that the investor can just pick up a mobile phone and be able to invest through his broker anytime T, be able to access the market for information at any time T. And that is what we want to do as quickly as possible. Come in 2-3 weeks' time, we'll be launching one of them at maybe this place or the exchange. So that's one of the key things I want to do when it comes to infrastructure, improving the technology that we're using on the market. And last but not the least, we need to educate our people about investments. Without investment, there's no future. You need to invest for your future. And that is why it's important that we have all of you gathered here. You're holding the pensions of so many people, over 1 million workers, right? Or 2 million workers in Ghana, and other people. How you invest them and the returns that you make for them is very crucial to them. And it's also crucial to the development of this economy. So all these initiatives that I talked about are aimed at transforming Ghana Stock Exchange from what we call a frontier market to an emerging market, and therefore become the preferred platform for investment and capital mobilization to support national economic development, as enshrined in our mission. We can only achieve this when we have the collaboration of all of you, regulators, pension funds, regulators, asset managers, license dealing members, and all of you gathered here. So I thank you so much for attending this very important workshop, and I wish you a very fruitful and successful program. Thank you very much.
Thank you very much, MD. Can I please give him another round of applause? One of the key statements that he made, which all of us should make an effort to engage people on, is that he said, without investment, there's no future. So we need to, wherever we find ourselves, we need to encourage and get people to actually invest so that all of us can enjoy a better and a brighter future. Next to speak is a seasoned banker, an investment professional. He's also an investment actuary with proven business development experience, an executive presence with over 20 years progressive experience in pensions and fund management. He is a former AD of GSC with Data Bank and of GSIA with Fidelity Asset Management. He's a founding CEO of Fidelity Asset Management Limited, now Fidelity Securities Limited, and a former treasurer of Fidelity Bank, and a member of Actuarial Society of Ghana and CFA Institute. He's currently the Deputy CEO of the National Pensions and Regulatory Authority. Ladies and gentlemen, I now welcome to the podium Mr. David Tete Abe-Ame to give us his remarks. Let's welcome him with a round of applause.
You know, when they read such a long profile about you, your academic credentials and your technical expertise, a lot of the time, it can be positive and it can be negative. There's so much expectations. But nowadays, I do less technical work. And as a regulator, together with Abina and Mr. Kwafezi, we try to sensitize the market on pensions. I was at Asesewa, the first time a Ghana traveled that long journey along mountains, and I was at Asesewa on Tuesday during the holiday to sensitize the informal sector about pensions. And this was a call by the Minister of Employment and Labor Relations that we need coverage of the informal sector, because from the statistics, about 11.2 million working population, only 2.2 are in the formal sector contributing to SNET. So there's a big chunk there who are not on any form of pension or the other. And he has given us to move this penetration from 3% to 40% by 2026. And I believe that in that kind of coverage and mobilization of contributions, we'll be able to channel some onto the stock market, as we'll come to talk about it. So DG of SEC, Osofo, was with me at Data Bank as my head of Christendom so many years ago, and I'm happy that at the time that I became the Deputy CEO of MPRA, he's also the Director General of SEC. The MD and DMD of the Ghana Stock Exchange, Mr. Kwafezi and Abina, we go way back. When I was an ABO at Data Bank Brokerage Limited, Abina was at SAS, and Mr. Kwafezi was still at the Ghana Stock Exchange. That is in the 90s. And at a time like this, we are all at the forefront of regulation and championing market penetration. So I'm very happy that I am associated with this thing. So when they brought the issue to us at the MPRA, my CEO put me in charge, and because of this long history of collaboration along my career, we've been able to make this program successful. And I also want to welcome the service providers of the pension industry, the corporate trustees through the chamber. I think have done very well. We were able to give access to the Ghana Stock Exchange directly to the chamber to be able to bring the corporate trustees. And then we handle the employer sponsor schemes from the Standards and Compliance Directorate. And that is how we work together to make this workshop possible. So ladies and gentlemen, good morning. The CEO of the MPRA would like to extend his support to this wonderful collaboration with the Ghana Stock Exchange in discussing the way forward, how pension schemes can invest on the Ghana Stock Exchange in making real impact in the Ghanaian economy. I remember when we were going to review for the third time the investment guideline. Osofo here happened to be the chairman of the review committee. The board chairman of the MPRA said that this time he wants the investment guideline to affect the real economy. And for that matter, when we are reviewing it, we should consider that. And I'm happy to say that as I come along to show you some statistics, you realize that the new one which the board will approve and will come to play with you, the service providers, you will see certain introduction of asset classes that will help to achieve that purpose. The Ghana Stock Exchange and its listing and membership requirement to issuers of securities on their market makes it an appropriate avenue where transparency and accountability on the use of funds invested can be assured. The continuous collaboration among regulators and markets will also go a long way to ensure the stability of the financial security system in this country at a time when the trust in the whole sector is low. I saw that at Asesewa, when a lot of the market women were asking questions about microfinance companies that have duped them, fund management companies, susu collectors, and it was very challenging. I was there with the minister and my CEO, and you could see the mistrust on their faces. We were there with some service providers.
Good morning, ladies and gentlemen. With your permission, I will stand on existing protocols. And let me start by bringing you greetings from the Securities and Exchange Commission. And I'd also like to commend the Ghana Stock Exchange for this initiative of bringing together pension fund managers, pension fund trustees, and other relevant stakeholders for this workshop. For the SEC, we subscribe, or we believe, or we support this initiative because indeed it falls within our mandate. Our mandate, captured in our vision, is to regulate, innovate, and promote the growth and development of an efficient, fair, and transparent securities market in which investors and the integrity of the market are